All right, ladies and gentlemen, you're welcome to this wonderful educational series with EBC. My name is Precious David, and today we're going to be looking at what exactly you need to know, all the things you need to know to be able to get yourself profitable. And trust me, I understand how it feels. I know the reason why a lot of you are here. You want to know exactly how to trade, how to make money in this business, and trust me, I got you. All right, I've got you. But first of all, I want to quickly take us through Module 1. And Module 1, in this section, we're going to be talking about, I'm going to be introducing myself to you. I'm also going to be introducing your broker to you. If you don't know what a broker is a middleman between you and the global financial market, meaning that a broker is the one that gives you access to be able to trade. Essentially, a broker is all you need to be able to get access to the market, to buy and sell gold, buy and sell currencies, whatever you want to buy and sell, and make money. So whatever amount you've deposited in your account, or you want to deposit in your account to be able to make money, your broker is the one that's going to turn that idea into your reality. All right, so very quickly, let me just quickly get through myself. My name is Precious David, and I've been doing this for almost 10 years right now, guys. And this is what I do 100%. All right, this is where I make money 100%. My first 1 million naira, like I shared with you earlier, was made here. It wasn't easy, and that is the reason why I am very happy. I'm very glad for those of you that are listening to this webinar series right now, because I'm going to be sharing with you some of my mistakes. I'm also going to be telling you how not to make those mistakes. All right, so very quickly, let me just quickly go through myself. I'm a capital market and capital market and security analyst, certified by SCFI. I've also written some books, The Complete Trading Plan, which is essentially a book that tells you how to actually have a trading plan for your business, because trading is a business and you need to have a trading plan. All right, the next one is the Almighty Trading Formula. Now, these books are available on Kindle File if you are interested in getting them. I've also founded some companies, some trading companies like Consistent Traders, Cash Out FX, and also have a major educational company that is going to be launching very soon, Trade to Wealth. If it has not already launched, I don't know, anytime, if you're watching this probably a week before I dropped it, a week after I dropped it rather, then probably we are still looking at launching. But if you're watching this 3 months after, it means probably we've launched right now. And of course, the major broker we're actually sponsoring for this is EBC. Okay, so let's quickly get right into it. I've also taken some time in the last almost 10 years right now to organize different seminars, from universities to educational platforms to having radio programs all across Nigeria and outside Nigeria. These are some of the seminars I've been able to hold in Nigeria. These are some of the awards I've been able to get in Nigeria from the business of educating people in trading. This was the program, the seminar we had in Ilorin, Nigeria. This was in Abeokuta. This was in, I think it was in Lagos, thereabouts. So all this just to show you that I've been doing this for a long time, and my job and my passion is to actually teach people what I have been able to do that has given me some level of financial freedom to actually teach it to people. And this is why I'm really, really excited. But before we really go into the course majorly, let me share with you who EBC is and why you want to trade with us, why it is good that you are here. It is good that you have an account with us. And if you don't have an account already, please make sure you open an account. Why you need to, what you need to know about EBC before you start trading. Number one, EBC is a global brokerage firm, multi-regulated, multi-located, and top-notch. I'm not just saying this because I'm part of the team. I've worked with over 6 brokers, very popular ones. If I mention their names, some of them you know. And so I'm saying this as a fact, all right, that EBC has everything you need as a trader to be able to scale your trading business to the top. All right, so what do I mean? Number one, EBC is multi-regulated and it is multi-located, meaning that we are in different countries, from Europe to UK to Africa to Latam. We are everywhere, and we have regulations in all these regions. Everywhere we are regulated, in every region, from Europe to the UK to Latam to Africa. We are regulated in all these regions. Not just that, we are also the brand partner, the official partner of FC Barcelona. All right, EBC is the official partner of FC Barcelona, and that tells you a lot. That should tell you a lot. That alone should tell you a lot. All right. Apart from that, also, like I've mentioned this, we are top regulated, and we have, we are internationally recognized. You can check our ratings on MyFXbook, Trustpilot, WikiFX, and it's all there. All right. We are also related to all these guys I just mentioned already: MyFXbook, investing.com, World Finance, Finance Magnates. Top notch, guys, top notch. So EBC doesn't just give you the platform. EBC also gives you the platform with class. So you're not just trading with a broker, you're trading with a world-class broker, not just with the name, but that has the records to show for it. So it's a very exciting time, and I'm really, really happy and excited for every one of you that have actually come to join the movement, which is EBC. Okay, so let's quickly move on to what we bring to the table, what we give to you as our value clients, value traders. Number one is safety, which is very, very important. Not just regulations, but safety of capital. EBC have been able to partner with major hedge funds and major financial institutions like Barclays to provide secure custody and robust asset protection to guarantee the safety of your funds, which is very, very important. Fairness also is also one thing we are also very big on. We are big on fairness. Dedication, we are very dedicated to you. We also bring a lot of value. We're always looking at ways to make it easy for traders to make more money on the platform, to do things seamlessly. Integrity is a big thing for us also. We are people of very high integrity, and we are always very concerned about how we are also showing up for you. Number two is responsibility. We are very, very responsible to our traders, who are also very, very responsible to us. All right, I need to quickly say that. We are very responsible to traders who are very responsible to us. For example, this lecture you're getting right now is not actually free, but you're not paying anything for it. So it's free for you, but it's taking a lot for us to actually put it together to bring before you, and we're giving you the best. Okay, so very quickly, we are also not just all about the money, it's not just all about the trading. EBC, like I said, is a movement. All right, we are also partnering with the United Nations Foundation to build equitable and healthy society. For example, we have been partnering with the UN Foundation to make sure that the fight against malaria is done with us in conjunction. All right, we have been partnering with UN to fight malaria in major countries in Africa and outside Africa, for a long time right now. So this is just to show you just a little bit of what we've been doing. And like I said, we have the best. This is top tier international team. This is meets David Barre, our CEO and of EBC Financial Groups, and I mean, top notch, guys, top notch. So very quickly, I'm just going to be leaving all this. At least by now, you have an idea of who EBC is. You have an idea of who I am. And so therefore, let's quickly go to why we are here, the reason why we are here. So I'm just going to be skipping all this. You can actually get this on your own much later. You can read. All right, so we are in module 2 right now. In module 1, I took you through who I am and who EBC is, and I think we've been able to do that. If you have not seen that module, please go back to see that module. It's very, very important that you know who you are doing business with, what they do, and how trusted they are. It's very, very important to know who you are doing business with, what they do, and how trusted they are before you start anything. All right, and that also applies here. In this module 2, we're going to be talking about introduction to e-trading, which simply means electronic trading, and the global financial market. We're going to be talking about some terms. We're going to be looking at an overview of what the market stands for. So if you're ready, I'm also ready. I'm also excited. Let's quickly get into it. All right, the first thing we're going to be looking at is, what is the global financial market? What is the global financial market? Now, the global financial market, if you look at the word global financial market, you discover that there is a familiar word right here, and that word is called market. All right. Now, the word market simply stands for a space where buying and selling takes place. For example, this is a popular market in Lagos, Nigeria, called Oshodi Market. Very popular in those days, have a lot of population. If you look at this market, you discover that there are only two categories of people that matters in this market: the buyers and the sellers. It doesn't matter their religious background, it doesn't matter their ethnic belief, it doesn't matter their age or their gender. It's either you are a buyer or you are a seller in the market. Now, what this is trying to say is that in every market or in any market, whether it is electronic or it is physical, there are only two categories of people, or there are only two activities that matters: buying and selling, which eventually leads to profit if you know what you're doing. So the global financial market is a market where buying and selling is taking place at a global scale. And what we are buying and selling are not perishable crops like what you're seeing here. Like, we have tomatoes, we have onion, we have rice. What we are interested in are called financial instruments. And that is why we call it the global financial market. Because what we buy and sell in this market are called financial instruments. Make sense? All right, so let's move on. Now, I've been able to talk about this. Okay, one thing we need to actually understand is that the key difference between the global financial market and the physical market is that apart from the fact that the global financial market is online, you don't need to go to anywhere physical. There's no closing time or opening time. For example, the global financial market opens from Monday to Friday at every time. Although there are times where the market goes to a brief close, but probably 1 or 2 hours depending on daylight savings time. But majorly 1 or 2 hours, 3 hours max, depending on the financial instrument that you are trading. But for major financial instruments like currencies and commodities, 1 to 3 hours max. All right. But after that, the market resumes again daily from Monday to Friday, which means you can wake up in the middle of the night in Nigeria, and by 2 a.m. in the morning, you are trading probably oil, you are trading Euro, USD, you're trading whatever you want to trade, and you're making money while everyone is sleeping. And this is not achievable in the physical market. Now, this is one of the major differences that you actually need to know, that on Saturday, Sunday is the only time the global financial market for major instruments like currencies and commodities are actually closed, including stocks. Now, what am I trying to say in clear words? Saturday and Sunday for foreign exchange like Forex trading, commodity trading and stocks, you cannot trade on Saturday and Sunday. But from Monday to Friday, you can trade at any time. I'm going to skip all this and I'm going to move to the evolution of e-trading. Now, e-trading started as computerized trading in the 1980s, and today, with your phone, with your laptop, with your tab, you can begin to trade and make money from your device, as long as those devices can connect you to the internet and you have a broker like EBC that can actually give you access to the global financial market. Now let's move on. Let's quickly go and answer 3 important questions that every trader should know. There are 3 important questions that every trader should get themselves acquainted with. Number 1 is, what is tradable? What are we trading? Number 2 is, who is trading with us? Who is trading with us? Who are those that participate in this market, or who are the market participants? Number 3 is, when and how to trade. So let's go into answering question number 1. What is tradable? Ladies and gentlemen, tradable instruments, or majorly known as CFDs, which is contract for difference, has to do with major currencies to metals and can be broadly classified into the following classes. Number 1 is currencies. Number 2, we have commodities. Number 3, we have indices, and the last one, we have stocks. And this is the reason why I'm not teaching you about Forex trading. I am teaching you about e-trading. Why? Because Forex trading is just a part of the portfolio. The word Forex starts from foreign exchange and is also known as currency trading. I repeat, Forex trading is just a part of this portfolio. The portfolio is, we have a lot of portfolios. We have the currency portfolio, commodity portfolio, indices, we have stocks, we have cryptocurrencies also. So the portfolios, we have a lot of portfolios, all right? And this is not, we still have a lot of other portfolios. But currency trading, which is Forex trading, is just one out of all these portfolios. So what I'm teaching you right now, the aim of these lectures, this series, is not to teach you how to trade Forex, no. Is to teach you how to become an e-trader properly. So let's quickly look at what currency trading actually means. Let's look at what commodity trading actually means. Let's look at what indices trading actually stands for, and look at what stock trading actually means. Alright, so we've been able to talk about currencies. Let's talk about currencies now. Currency is defined simply as a bill of exchange, acceptable as a legal tender for payment for goods and services. However, currency trading, which is different from currency itself, is the exchange of a nation's currency with that of another nation. Let me just put it in simple terms. What we are trying to say is that for you to be able to trade currencies, you need to trade it in pairs. It means if you want to make money from the dollar, you need to pair it with the euro, pair it with the card, or pair it with another currency. You can't trade just one, you have to pair two, which is a very, very interesting thing to know, that currency trading can only be done in pairs. There are other things that can be done in pairs as well, but currency trading is one of the major things that can be done in pairs, unlike commodity trading. Now, what we are saying in general is that for you to be able to trade currencies, you need to pair it. So let's quickly know what are the types of currencies that we have and what are the pairs that we have out there. Number one is that we have the major currency, which has to do with the dollar, the euro, Japanese yen, Great British pounds, Swiss francs, Canadian dollar, Australian dollar, New Zealand dollar. Then we have the minor currencies, and these are the list of the minor currencies, from Brazilian real to Norwegian krone. We also have the exotic currencies, from South African rand to Turkish lira, and so on and so forth. Now, make sure you understand that there are three. The major thing you need to understand is that there are three currencies: the major, the minor, and the exotics. When it comes to currency pairs, there are also three types of pairs. We have the major pair, we have the minor pair, what's known as the cross pair, and we have the exotic pair. What are the major pairs? A major pair is any pair that has a major currency paired with the dollar. I repeat, a major pair is any pair that has a major currency paired with the dollar. And you can see it here. Euro USD. Euro is a major currency paired with the dollar. That makes it a major pair. And we have other examples as you can see on my screen. And we also have the cross pair. So anytime we have two major currencies paired together in absence of the dollar, where the dollar is not in that pair, we call it a cross pair or a minor pair. All right, so we have the Euro GBP, Euro CHF, every other major currencies being paired together. These are like a variation of major currencies being paired together in the absence of dollar, or with the absence of dollar. We have a variation of minor currencies or cross pairs. Then lastly, we have the exotic currencies. These are currencies, exotic currencies that are paired with major currencies like dollars, like the dollar or the euro or any other major currency. Why is this very important? Take note of this. As a trader, one of the best ways to go into currency trading is to trade either the major pair or the minor pair. Why? I will tell you why. The reason is because you pay less in terms of spread. If you don't know what spread are, don't worry, we're going to talk about spread very soon. But in general, spread is like a fee that you pay. It's very little fee that you pay to trade, when you go into a trade, either a buy or a sell on all these currencies. So when you trade major currencies or minor cross pairs, you have lower spread, which means you have a lower fee to pay, which eventually increases your profitability, because it also means that you also have a higher profit margin. All right, so stick to the major pairs, stick to the minor pairs, and trade less of the exotic pairs. Now, what's the major advantage of trading currencies? Number one, cost of trading is low. You can start currency with a very small amount and you can actually manage it, build it up. No market control also is a major one. Profit potential is also very high. Forex trading has the highest turnover, over 8.5 trillion dollars daily. All right, it has the highest daily turnover, and we also have high liquidity, which also talks about the high daily turnover. Now let's move to the next one, which is commodities, which is actually my own personal favorite. Commodity has to do with trading of basic goods used in commerce. All right, most often they are used as inputs in the production of other goods or services. Example is metal and energy. We also have agricultural produce like cocoa, cotton, but I'm just giving you a list of what we offer here at EBC. We have metals and we have energy for you to trade. So In metal, on talking about metals, what are the things that we offer? We have gold, we have silver, we have palladium, we have platinum, we have zinc, a lot of them. But gold is the major metal when it comes to trading. Gold is being offered by a lot of platforms, including EBC, at a very very good rate. So you can actually trade gold to make money. Apart from gold, there are other options for you to trade. But like I said, gold is a major metal. And the reason why gold is a major metal is because gold is an alternative to the dollar. Please take note of this. Gold is often known as a safe haven for the dollar. So it's like a risk-adverse instrument. When the dollar is actually not stable, or when the dollar is actually going down in value, the price of gold always goes up. So gold is inversely proportional to the movement of dollar. So the dollar is going up, gold is going down. If dollar is going down, gold is going up. Most of the times. All right. Then we have crude oil or energy. Under energy, we have crude oil, WTI, and we also have Brent. We have natural gas. And to actually make money from these ones, all you just need to do is to pay attention to OPEC and what they are saying about inventory. What is inventory? Inventory has to do with the number of supply that is in the store, and also gives you an idea of what they are also releasing into the market, gives you an idea of the demand level. So if the inventory keeps on getting higher, meaning that if the number of barrels of oil in the store keeps on increasing at every data outputs, at every time they release the data, then that tells you that the demand for oil is not as much as it should be. And of course, that is going to affect the price. It's going to push the price down, because it tells you that people are not buying oil. But if it's getting lower and lower, it means the demand for oil is very high, and the degree at which it's getting lower or the degree at which it's getting higher also affects all these things. So what we're talking about when we're in module 4, when we're looking at technical analysis and fundamental analysis, I'm going to be breaking this down more. So please stick around till that time. Okay? So all you just need to understand right now is that you can also trade crude oil, and you can make money from them if you understand the demand and supply and how it works globally. What's the basic benefit of trading commodities? Well, I think apart from every other thing, one major thing for me is diversification. You can diversify your portfolio, and of course, high return. You make a lot of money from trading commodities. All right. Now, the last one is stocks. Now, a stock is an ownership share in a corporation. Each of these shares denotes part ownership as a shareholder or stockholder of that company. For example, if you're a shareholder to EBC, by the time EBC is declaring profit at the end of the year, you also have a share. That's why you're a shareholder. All right. It's as simple as that. And the word shareholder means I have a share in the company. As simple as that. All right. So examples of companies that you can actually trade their stocks or buy their shares on the platform include Apple, Netflix, Amazon, and so forth and so on, including Meta. All right. Now, apart from stocks, we also have indices or index. So what is the difference between indices and stocks? Very simple. Just see it as plural and singular. It's as simple as that. So what we are trying to say is that the singular form is stocks, while the plural form is index. So what we are saying is that when you have a single company, we call it a stock. But when you have 5 companies, 3 companies, 2 companies combined together, we can call that an index or a market index. All right. So which means that, let's say in the sector of technology, Meta is a fintech company. We can say Meta is just a stock. But when you combine Meta and Amazon and Microsoft together, we can say this is a market index, because they are all in the same, market category, and at the same time, they have been combined into one. For example, the Dow Jones has to do with 30 companies in the United States. Dow Jones is an index because it's a combination of 30 companies. We also have S&P 500. We also have NASDAQ, which is a combination of 100 companies in the United States. We also have US 2000, all right, US 500, and so on and so forth. In Nigeria, we also have what is called NSE-ASI, which is a combination of a lot of stocks in Nigeria, combined into one market index or a particular market index. So what is the advantage of trading indices over trading a single stock? It's as simple as, it's very simple and straightforward. What it means is that, for example, if I buy into the stocks of Meta, Amazon and Microsoft, for example, and for one reason or the other, Meta is not doing so well, and let's say all of them have the same market capitalization. Market capitalization means that they all have equal power, equal financial power. I don't want to use so much terms, all right? So just what I'm just trying to say, market capitalization means that they all have the same strength, financial strength. So if Meta is not doing very well as a company, I still have Amazon and Microsoft. I'm not losing my money yet because I still have two that can still help me to still make profit or break even at the end of the day. So it's like I am trying to have a basket of multiple assets in order for me to be able to have a very good footing, to like a risk manage. It's like a risk management kind of a thing. So I'm trying to have multiple options so that if one doesn't work, I still have a lot of other options that would work and my money can still give me profit. Rather than putting all my eggs in one basket, I am putting my eggs in several baskets. You understand? So that's just as simple as that. Now, there are so many options for you to trade, but this is my advice for those of you who are just starting to do this business. One of the best ways you can do this is to pick the one that you really want to do. What do you want to trade? Do you want to go into currencies? Then focus on it. And not just go into currencies. What kind of currency do you want to trade? Pick a particular currency and know everything about the currency. If you're going with Euro USD, know everything about Euro USD. For me, I trade majorly. Most times I trade gold. And if you wake me up in the middle of the night and ask me what is happening with gold, I would give you something. I would tell you something, because every day I am always checking the news. I'm always seeing what is happening in the United States, because gold is majorly moved by what is happening in the United States because it's very tied to the dollar. So I can tell you very fast what is happening without really stammering or trying to guess what is happening over there. So it's a very, very important thing for you to understand that paying attention to one of these things without paying attention to all of them gives you more of an edge than you being jack of all trades. All right, take note. So let's quickly move to market participants. Who are those that are participating in this market? Number one are central banks. We have governments. We have investment corporations. We have businesses worldwide. And lastly, on last down the chain, or the food chain, or the trade chain, if you permit me, we have the retail traders, you and I, me and you. All right, so we are called retail traders, and we are the one that are the lists of all the market participants that we have in this business. Let's move on. What influences this market? Number one is political events and conflicts around developed countries. For example, when Russia invaded Ukraine, the markets was a little bit destabilized. Where the old Israel and Iran issue also, involving the United States. These are also issues. These are conflict around developed countries, and they affect the market. Trump policies on tariff, they affect the market. Then we also have key economic events such as interest rates, CPIs, PPIs, GDPs, inflations. They also affect the market. And lastly, we have key monetary policies by head of banks like Jerome Powell, who is the chair for the Federal Reserve. All right, so whatever he says about monetary policy, mostly from the FOMC, or whenever he gives a speech about the monetary situation, the financial situation of the United States and give a global review of what's happening economically, it affects the market also. Now, if you understand how to take advantage of all this news, you are going to make a lot of money. Trust me, you can make a lot of money. If you can take advantage of all this news. And that is why in module 4 of this lecture, I'm going to be talking about fundamental analysis, what they are, how you can get them, how you can trade the markets. Trust me, it's going to be a blast. Just stick with me to the end, and I know that by the end of this series, you would really be very knowledgeable to start making some very good profits in this market. Okay, so let's quickly move on to market sections. Number one, we have 4 types of market sections. Number one is the London section. We have the New York section. We have the Sydney section. We have the Tokyo section. All these are GMT alone, so you can Wherever you're watching me from, whether you're in Nigeria, you are in Kenya, you are in South Africa, you are in Ghana, or you're outside Africa, you are in Europe, you are in the UK, I mean, you are in Asia, you can just put in your GMT configuration, if it is +1, if +7, +2, +3, whatever you have, and then you get the time value for all this. Moving on, we have how to trade. How do you trade? Now, essentially, there are three positions. Well, there are two positions you can actually take, but majorly I tell people that there are three. What you're going to be told is that there are two positions. You can go long, you can go short, which means you can buy and you can sell. Invariably the same thing. We're actually saying the same thing. To go long means to buy. To go short means to sell. If I say I'm shorting Euro USD, it means I'm buying I'm selling Euro USD. If I say I'm going long on Euro USD, it means I'm actually buying Euro USD, or taking a buy position on Euro USD. Now, there's the third one, which is not so common. You can stay out. You can wait. It's not compulsory for you to take trades. If you don't have a very good signal, or if you're not seeing something that is giving you a very good analysis and a very good reason for you to buy or sell, just stay out. So staying out also is an option. It's also a position you can actually take. All right. Now, how do you buy and sell? It's simple. We're going to be looking at that practically, but let me just give you a graphical representation. All you also want to do is that you want to enter your price. You can do this instantly. You can do this using pending order. I'm going to talk about types of order later on in our next module. But for this one, all you just need to know is, let me give an example. Let's assume let's assume that a pack of bottled water in Nigeria is sold for 2,000 naira. Well, let me use dollars since it's much more universal. So a pack of bottled water is sold for $2. All right. At the wholesale price, but the retail price is at $2.50, which is $2.50. Now, this means that if I buy a pack of bottled water at $2 from the wholesalers, I can resell at a retail price of $2.50, which is my take profit, which is where I want to sell. I don't want to sell at $3. It's not because I don't want to make more money, but because I know that people are not going to buy at $3. The current rate is at $2.50. So if I sell it above $2.50, I might not get anybody to buy it. I mean, nobody's going to buy it at that price. You understand? So I want to take my profit at $2.50. I also don't want to sell below $2.50. I could also decide to sell at below $2.50. I could decide to sell at $2.30, $2.20. But no, I don't want to. I could decide to, but I don't want to, because I know the market value. The market value should be able to get me to a take profit point of $2.50. So $2.50 is my take profit point. It means that is the point at which I want to sell. That is the point I want to sell after I've already bought. That is the point at which I want to take my profit. I want to close my trade in profit and come out of that trade successfully. And this has been going on for 2 years, which means every time I buy a pack of bottled water for $2, I sell it for $2.50. Everybody knows this. It's common knowledge, right? But you have to understand that a news could come that could damage the company's reputation. The company's reputation, the company you're getting the bottled water from, a news could come to damage their reputation, and people could decide not to buy from that particular brand anymore, and you could lose money if that happens. Though that is very rare, right? But in trading, you still have to have a plan B. You still have to have what's called a risk management. So even though you are so sure that even if I'm buying at $2, I'm going to be selling at $2.50, I already have my customers waiting for me, you still have to have a plan B to say, what if that doesn't go according to plan? What is going to be my stop loss? Where am I going to be mitigating this trade? If anything happens to the brand and I cannot sell, let's say I bought 10 packs, I cannot sell at $2.50, and people are not pricing it below $2.50, how do I quickly sell off to be able to recover my money so I don't lose so much? So I can say, okay, worst case scenario, if anything happens, beyond my control, I should be able to sell at $1.80. I will lose 20 cents on each of my transactions, but it's still okay. At least I still have 180 cents, and I will recover eventually, rather than losing all my money because nobody is buying the goods from me. This is called a stop loss. This stops you out without you losing so much, so that you have at least a very good portion of your capital to take the trade, maybe buy another brand and make your money back eventually with time. Same thing for the sell trade. So you take a sell, your same price is going to go down to a particular price where you want to actually buy back at a cheaper rate, or you want to close your trade in profits, which is your take profit point. But at the same time, you can also know that there could be something that could happen, that after you have already sold and you're expecting price to come down for you to buy back, that thing could happen that the price will not come down. Now remember, you have sold already and you are expecting price to drop so that you can buy back cheaper, right? I saw that, let's say $2, I'm expecting the price to drop to $1.50, so I can buy back at $1.50, so I make 50 cents on each of the, let's say I bought 10 of the packs of 10 packs, so I make 50 cents times 10, which is about $2.50, right? But right now, something has happened that has caused the price, after you have sold, remember, and you have to buy back, it's compulsory. Now, something has happened that has pushed the price from $2 to maybe $2.20, which means right now you are now losing 20 cents, because if you decide to buy back at 20 cents, you are losing 20 cents. But the thing is this, if you decide to wait, the price could keep going up to $5. At that point, your position will be mitigated if you don't have enough funds. So what you want to do is that you want to put a stop loss at $2.20, even though it might not happen, but just to be safe, you want to have your stop loss at $2.20, and when price gets there, it mitigates your trade. You come out of that trade losing only 20 cents per order, and you are good to go. You can still take other positions when the market is more settled and when you are more sure to recover your losses eventually with time. Now, these are not set in stones. All these $2.50, all this price I'm mentioning, they're not set in stones, and they are actually a little bit much more interesting than that. And we're going to be doing it practically anyway. But this is just to give you a rough idea of what buying and selling entails in the business of trading. So, having said this right now, I want to believe that we understand what it is. So, this is like a practical diagram of what it looks like. So you can see. We took a trade here. This is a buy trade. We're expecting price to go up to it, our take profit, but we also have our stop loss here. All right. So once this price goes up, takes our profit, we're out of this trade. If it goes down, we're out of the trade also, but we're not going to be losing so much. And what we are risking compared to what we want to make, you can see we are making more than what we are risking, which is a very good risk to reward ratio. We call it a risk to reward ratio. Now, if you look at this critically also, you discover that I also need to tell you this. Interestingly, if your phone is stolen, if maybe your internet goes off, something happened and you've actually set this, you've put this order, this stop loss order and the take profit order already, you don't have anything to worry about, because it means that when price gets to either of these levels, your trade is going to be stopped, either in profit or in loss, depending on which level it gets to. This is a sell trade, and you can see we're expecting price to come down. We sold here, and we have our stop loss here, we have our take profit here. All right, so this concludes it for us for this module 2. Remember, trading, you can trade from anywhere in the world. You don't need a boss, employment, office, or inventory. You can start small, you can start big, you can start with minimum investment and overheads, unlimited profit potential, immediate income. You can do it part-time, full-time, 24 hours a day, and you can trade at your own leisure. And for me, trading is all I do. All right, this is where I make majority of my money. Majority of my money comes from trading, and it's a very interesting business when you get to understand it. Remember, I say it's a very interesting business, and it's not a get-rich-quick scheme. All right, so you have to understand how the business of trading works, because that is the only way you can actually make profit. And as we go in this lecture, I'm going to be opening a lot of secrets to us, secrets that I've been able to understand myself over the years, so that we don't miss it in this journey of becoming professional traders and making money from trading. I'm going to be seeing you in the next module, which is module 3, where we're going to be talking about terminologies, what is pips, what is margin, what is available margin. I'm going to be seeing you in that module. Have a wonderful day, and I'm going to see you in module 3. And I want to congratulate you because you have gotten to this module. This is module 3, and here we're going to be looking at trading terms and platform navigation. I'm also going to be doing a lot of practical here with my phone, because I know majority of us are trading with our phones. So I'm going to be doing a lot of practical with my phone, and Yeah, so stick around. Let's see how far we can quickly go. The first thing I want to do is that I'm going to be breaking down a lot of things, a lot of terminologies. For example, let's start with, I think I've talked about who is a broker. A broker is a middleman between the trader and the exchange. And there are different types of broker. For example, EBC is an ECN broker, which means that they take you directly to the market without any manipulation whatsoever. But there are other brokers that are market makers that, you know, do a lot of manipulations. We're also going to be talking about MT4. What is MT4? What is MT5? MT4, MT5, they are platforms, trading platforms that are created by MetaQuote. MetaQuote is the company that created the MT4 and the MT5 way back in the year 2000. I think 2003 or 2005, I can't remember. Between 2003 and 2005, they came up with the idea of MetaTrader 5, MetaTrader 4 to give people the opportunity to be able to have an app that connects directly to the global financial market through the broker. All right. So you need to have this downloaded on your phone. If you don't have it downloaded on your phone yet, we're going to be using it in this module. So make sure that you have the MetaTrader 4 or the MetaTrader 5 downloaded on your phone, your laptop, your tab, or whatever device you want to use to start trading and you want to use to start making money from trading. All right. So let's go quickly into it. Now, the things we're going to be talking about, the agenda for this module is: number one, we're going to be looking at trading terms, equity, lot, pips, bid, ask, leverage, margin, available margin. Platform, we're going to be looking at a more practical approach to MT4 and MT5. I'm going to be using MT5 though because it's much more for manual traders. If you understand MT5, you practically understand MT4, just a little bit difference. We're going to be looking at market orders, types of market orders, spending and instant, what is take profit or stop loss. And we're going to be doing all this practically also. So let me start from let me start from explaining to you the trading terminologies that we have. And I'm going to be using this picture to explain everything. Now, there's a lot of, you can get this manual from your BD. There's a lot of information about trading. Mostly when it comes to terminologies that can be very confusing. What is margin, available margin, bid price, ask price, spread, leverage? Very confusing, right? And for somebody like me who started trading on my own from YouTube videos, made a lot of mistakes. For 2 years, I wasn't profitable. I learned a lot of lessons. And I discovered that trading is very easy, guys. Trust me. Trading is super easy, but a lot of times people like to complicate it a lot. Trading is also different from what we've been doing for a long time now. Trading is also different from what we've been doing. So let me break it down to you. We have a young man who walks into a market, right? Walks into a market and goes directly to this guy who is selling oranges, right? So we have this guy from the north in that is selling orange, and this guy picks the orange and wow, this orange makes a lot of sense. I want to buy this orange. The next thing, or the first thing that comes out of the mouth of the seller, which is this guy over here, is going to be, how much orange do you want to buy? In the Nigerian pidgin language, it's going to be, Oga, how much orange you want to buy? So what it's trying to say in English, basically, is how much orange, what is your quantity, what is your volume? So you understand that the very first thing you need to determine anytime you want to take a trade on the platform with your broker in your MT4, in your MT5, is your volume. So when it comes to volume, another word for volume is lot size. You can call it volume, you can call it lot size. And there are three types of lot size. Let's quickly look at that before we come back. So there are three types of lot size that we need to quickly look at. Number one is the standard lot, number two is the mini lot, and the last one is the micro lot. Now, the standard lot has to do with 100,000 units of whatever you are buying. So, for example, Oga, I want to buy orange. How much orange do you want to buy? Give me 100,000 pieces of orange. What he's trying to say is that give me a standard lot of orange. A standard lot of orange means 100,000 pieces of orange, which eventually is can be valued at a standard number of 1.0. So 1.0 equals to one standard lot, which equals to 100,000 pieces of orange. So 2.0 is equals to what? Two standard lots. And of course, if you guess it right. 200,000 pieces of orange, because if 1.0 is equals to one standard lot, which is 100,000 pieces, 2.0 is equals to two standard lots, which is 200,000 pieces, and so on and so forth up to 50.0. There are brokers that offers 10.0, 30.0, but we offer even up to 50.0, for people who really want to go into this market and make a lot of money. Now, the next thing you need to understand is the next one, which is the mini lot. The mini lot has to do with 10,000 units. It's the value is 0.1. 0.1 equals to 10,000 units, which is one mini lot, so which is 10,000 oranges. And 0.2 equals to 20,000 oranges. All right. And last one is the micro lot, which is just 1 time, which is the smallest you can buy or sell in the market. Is a micro lot, which is represented by 0.01, and it's equals to 1,000 units. And if I put 0.02, it's equals to 2,000 units. Now, how does this affect your profit and your loss, or how does this affect your profit and the risk? It's pretty simple, pretty straightforward. Let's assume that I am buying one standard lot of packs of bottled water, and you are buying one mini lot of packs of the same bottled water. So I'm getting 100,000 packs of water. You are getting 10,000 packs of water. Let's assume that I make $1 each on each of the packs after I have sold them. It means I have made $100,000, while you have made $10,000. Even though we both did the same business, took the same trade, I have made more money than you because I have more. I used a bigger lot size than you. However, if it goes the other way around and I lose $1 on that trade each, it means I have lost $100,000, while you have lost just $10,000. See it? So it all depends on your capital. Don't overuse your lot size if you don't have enough capital. So always make sure that you are using your lot size based on your capital. For example, if you have, let's say, 100,000 naira to maybe like a million naira, and you want to trade currencies, you can be looking at between 0.01 to 0.05, or worst case scenario for currencies alone, 0.1, worst case scenario. But for gold or other commodities like crude oil, 0.05 for a million naira, which is roughly around $600 in dollars. All right. So it's something that you need to actually look out for, because it affects your profit. It also affects your loss. So we already understand that we have 3 types of lot size right now: standard lot, mini lot, micro lot. 1.0, 0.1, 0.01. And we know what they stand for in terms of the value you are getting. Now, Oga, I want to buy orange. This guy asks, how much orange, which is practically how much, what is your lot size? And this guy said, you know what, give me 10 pieces of orange, just 10. This is allowed in the physical market, but in our market it's not allowed, because the lowest you can buy is a micro lot, which is 1,000. But yeah, we can allow it here because it's just a physical market. Now, 10 pieces of orange. This guy said, all right, a piece of orange is 50 naira. It means that if you are getting 10 pieces, it means you're giving me 500. If one piece is 50 naira, it means you're going to be paying me 500 naira. All right. So let's pause there. Let's quickly get something straight. If he is selling one piece of orange for 50 naira, it means that he didn't buy it at 50 naira. Do you agree? Absolutely. What it simply means is that he bought each of this orange lower than 50 naira, which let's say 30 naira. Okay. So this guy who is selling the orange buys the orange at 50 naira. At 30 naira. He is selling it for 50 naira to make a gain of 20 naira on each of these oranges, which is not bad, What it simply means in our own business, in trading, in e-trading, is the same thing, practically the same thing. The only difference is the terms and the people involved. So let's break it down. It's the same thing. This is the broker. This is EBC. This is your broker. All right? And the broker has gotten the license of exchange to give you oranges or gold or crude oil or commodities or currencies, whatever you want to trade. Now, this is you, the retail trader, coming to the platform of the broker to trade. Now, you are telling your broker, I want to buy gold. And your broker is asking you, what is your lot size to buy? And I say, okay, I want to buy one standard lot of gold. And the broker is telling me, okay, if you're buying one standard lot of gold, it's very good. We're going to be taking the order for you based on your capital. However, our gold is sold, I'm giving an example right now, is sold at $5. I'm just giving an example, $5. Now, mind you, in the real market, gold is not going to be $5. Gold is probably going to be maybe $4.99 or $4.95, which means there is an extra 5 cents that has been added to the broker's price, to the quote price of the broker. Which means if you are buying this, you are buying it at an extra 5 cents, which invariably is the profit for the broker. Does it make sense? Now, the price, which is $5, which the broker is asking you to pay for gold on the platform, just like how this guy is asking this guy to pay 15 naira for one orange, is called the ask price. Why the price at which the broker actually got it from the liquidity provider or from the exchange itself, at which is at 4.95, or in this guy's case at 30 naira, is called the bid price, the price which the broker bidded or the seller bidded for the commodity or the goods. The difference in price, which in the case of these two people is 20 naira, but in the case of the broker and the retail trader is 5 cents, if it's 4.95 and $5, 5 cents, is called spread. And this is where the broker makes money. Spread. Now, the slimmer the spread, meaning the smaller the spread on the instrument, the more profit for you as a trader. And that's why you have a lot of brokers always saying, oh, we have very slim spread. Oh, we have for example, EBC are one of the best spread, right? But you see, spread is not something that you need to pay attention to that much. The only thing you need to do is to pay attention to the instrument that you want to trade, because there are different spread for different instruments. For example, like I told you at the beginning of this lecture in module 2, that major instruments, major currencies, major commodities have lower spread. For example, on EBC, we have one of the best spread on our standard account and our professional account for currencies and for commodities, including stocks, the best spread that you can have in the industry, right? But there are some exotic currency pairs that have very large spread, and it's not the fault of the broker, it's just because they are exotic currency pairs and they are really demanded for. So spread, like I said again, is the difference between the bid price and the ask price. That is spread. That is where you have the quoted price. So the quoted price gives you bid price, ask price, and then we have spread. Now, we've been able to understand what lot size is, what bid price, ask price, and spread is. Let's talk about margin and available margin. Let's talk about leverage. Ladies and gentlemen, there's a problem here. The problem is that Mr. Emeka, which is this man here, who wants to buy orange from Mr. John, which is this man here, does not have enough money to buy this orange. He has just 100 naira in his pocket, and he needs 500 naira to purchase 10 oranges, which is what he needs to produce a fruit juice for his customers on the island in Lagos. And now he has customers waiting. He has the best species of orange, sweet orange, that he wants to use. I mean, it's very rare, but he's seen it here, and he knows that this thing is of value, because even this guy does not really know what he has. I mean, and he's thinking, how do I get this thing to my house with this little amount I have? How can I buy it with 100 naira, even though it's worth 500? So an idea came to him, and he begins to speak to this guy. Mr. John, my name is Mr. Emeka, and my brother sells in the shop over here, which is just behind you. And of course, you must know my brother. My brother is, a very popular person. His name is Luke. You know him. So what I want us to do is that I want us to do business. I'm going to give you. I have just 100 naira, but I need to buy this today. So can you give me this on credits? Can you give me this on credits? Can I pay later for this? Can you give me a loan? So I have customers on ground already, so it's not going to be a problem. I'm going to take it to my house. I'm going to sell it off immediately, and I'm going to pay you back. Sounds fantastic, right? Now, Mr. John thinks about it for a while and said, okay, you know what? Let's do it this way. Give me 10% of what you want to buy. The amount of what you want to buy. Give me 10%. And take 100%. That 10% will serve as a collateral, or like what we use in finance term, deposits, like a deposit, a down payment for what you want to buy. Now, of course, this guy wants to buy something of 500 naira. He has 100 naira in his pocket, and 10% of 500 naira is 50 naira, so he can afford it. Ladies and gentlemen, what I have just illustrated to you now is how trading is being done. We don't have the money to trade. You don't have the money. I don't have the money. For you to buy just a 0.01 lot of gold. Gold, as I'm speaking to you right now, is at $3,700 or more. It's going to $4,000 right now as I'm speaking to you. Now remember, a 0.01, which is a micro lot of gold, just one micro lot of gold, means you want to buy 1,000 ounces of gold. Imagine 3,700 times 1,000 places. You don't have the money. Forget about it. You don't have the money. So the broker is the one that gives you that money to trade. When you take a trade with your very small amount, you have $500, you have $100, you have $200, you have $2,000, you have $10,000, it's still not enough. But when you take a trade and the trade is executed, the broker is the one taking that trade for you on the exchange with their own funds. And that thing they are giving you, that opportunity that you are getting from the broker to give you that fund to take trade based on your idea, based on the fact that you are saying that the price of gold is going to go up and you want to quickly buy, and they're taking that trade for you even though you don't have enough capital to take that trade on your own in a one-to-one leverage scenario. That is called leverage. So leverage is the power the broker is giving to you to trade using their own funds. They are borrowing their own funds to trade in the market, while your own money, which is in your own account, that money you have deposited in your account, is called margin, and that is the money you are going to use to access that leverage. For example, this man has 100 naira in his pocket and he needs 50 naira to be able to access a leverage of 500 naira. You can see it. So the margin that he needs is 50 naira to access a leverage of 500 naira, which means his own margin is 1:10. For every 1 naira, he can access 500 naira. He can access 10 naira, which means for every 50 naira, he can actually access 500 naira, 1:10. But EBC is giving you 1:1000. Does it make sense? 1:1000, which means for every $1 you have in your account, you can trade as if you have $1,000. So imagine you have $10 in your account. It means you're going to be trading as if you have $10,000. Ladies and gentlemen, this is what makes trading very interesting. You don't need to have all the funds before you start making money, because you have leverage to your advantage. All you just need to do is deposit your money, which is used for margin, and there are different margin requirements for different brokers. But in EBC here, we have the best margin requirement, which gives you access to be able to trade with even very, very low funds. And when you have a very good fund in your account, it gives you access to even trade, make more money with your funds. Now, take note of this. You can also over leverage your account, which means you can also use your full margin. We call it full margin. Full margin means if this man now says, you know what? If I put 50 naira down now, I still have extra 50 naira. Why don't I just use the entire 100 naira to buy a goods worth of 1,000 naira? So I get 20 pieces of orange at 1,000 naira with a down payment, which is a margin of my 100 naira. Remember, the entire 100 naira is all he has. If he's doing that, we call it full margin. He's going fully into the business. He's using everything. It's not always good in the business of trading. You need to have available margin. For example, if he uses 50 naira and he has 50 naira left, the 50 naira left is called available margin, which gives him an edge. In case the market does not go in his favor, he still has some money to be able to mitigate that risk. You understand? So available margin is always very, very good. Don't always go full margin, so that you can be on the safer side. Now, this explains every myth, everything that you have heard, all these very, very complex jargons that you can actually get from the business of trading. This explains it all. But there's still one more thing we need to touch, which is called pips. Now, the word pips stands for percentage in price movements. And before we talk about pips, let's really talk about, this very, very important concept called currency pairs in currency pair. In every pair, there's always a base and a counter or quote currency. For example, in this pair now, the base is always the first currency. Take note of that. Every time, guys, every time. The base currency is the first currency. Every time. The quote currency is the second currency. All right. So the base, first currency. Now in this case, our first currency is euro, which means our base currency is euro, and the quote is USD. So euro USD is a major pair because it has a dollar. Remember what a major pair is. If you have not seen that video, please go and watch my video on what a major pair is, which is module 2. Now, in this arrangement, what we are trying to say is that how many dollars do you need to get 1 euro? What will it cost you in dollars to buy 1 euro at a time? That's what we're trying to say. So let's quickly look at this. At the time I took this picture, for you to get 1 euro, you will need $1, 19 cents, 160 points. $1, 19 cents, 160 points. Now, let's quickly look at this critically. Why is this important? Because of this point. This is what gives you profit. A change in this point alone gives you profit. Now, remember we said PIP is percentage in price movement. Now, let's look at it. If price, maybe later in the afternoon, moved from $1.19160, which is $1.19, 160 points, to $1.19, 200 points. How many points has price moved? Price has moved 40 points. Am I correct? Correct. What if price moved from $1.119, 160 to $1.1900? It means price has moved 60 points to the downside. Now, why is this important? Because for every 10 points movement is equals to 1 pip. Every time price moves 10 points, it has moved 1 pip. A pip is equals to 10 points movement. Now, why is this very, very important? Let me quickly show you something. And this is very, very critical. Please stay with me. This is very, very critical. Good. Point in percentage, which is what for pips. Sorry, point in percentage, not price in percentage. Yeah, I think I said price in percentage. Okay. Or you can call it percentage in price movements. Is the same thing. Now, look at this. 10 pips equals to 1 pip. 10 points equals to 1 pip. 100 points equals to 10 pips. 1,000 points equals to 100 pips. So just use this 10 points equals to 1 pip. Now, every time you trade using one standard lot, remember one standard lot? Good. Every time price move 1 pip, you make $10, ladies and gentlemen. It means for every point, you're making $1 in your favor. And if it's against you, well, you also lose $10. Now, if you are trading with what's it called now? A mini lot, which is 0.1, the same way you're making $1 if price moves just 1 pip, which means for every point you have 0.10 cents, which equals to $1, you know. But if you're trading with a micro lot, 0.01, for every pip movement you are just making 10 cents. So excuse me. So you see it. One standard lot gives you $10 per pip movement. One mini lot gives you $1 per pip movement, and one micro lot gives you 10 cents per pip movement. Ladies and gentlemen, this makes it very, very easy for you to understand by the time we go into the practical section. I'm going to be seeing in the next practical section where I'm going to be using my phone to explain all this to give you a practical idea of what we are trying to illustrate. I'll see you in the next practical section. Make sure that you join me and you follow me. Man, I want to congratulate you because we have gotten to the practical section where we're going to be practicalizing everything we have learned so far. All right, so the first thing we're going to do is to create a demo account on the EBC platform. So the first thing you want to do is to log into your EBC platform, go straight to trading accounts, go straight to the home page. In front of the home page, you're going to see live account, you're going to see demo account. Click on the demo account and then it will lead you to this page. And when you're here, you can pick MT4, MT5. I'm going to be using MT5. You can pick between the STD, which is the standard demo account, or the pro demo account. Just pick the standard demo account. The currency is USD, leverage. For the demo, you have 1 to 500. For the real account, you have 1 to 1,000, right? So we're going to be going to 1 to 500 leverage. And I believe we already know what leverage is. If you don't know what leverage is, it means you need to go back and watch the video on leverage where I explain leverage on the third module. The deposit, I'm going to be going for $10,000, which is fine. I'm going to have my master password. I'm also going to be having my investor's password, and then I'm going to click on create. And it's just going to take a couple of time to create. So here we have it. I've been able to create the demo account, which I'm believing the details has been sent already to my email. So I'm just going to go to my email and I'm going to log in on that account on my MT5 account on my phone. So let's quickly go to my phone to quickly do that. So right now we've been able to log into our demo account. Let me show you. If I go to my MT5 right now, you can see EBC Financial Group. You can see my name also. We've been able to log into our demo accounts, and right here we have a $10,000 demo account. So we're going to be using this demo account to actually explain a lot of things that we'll be talking about. So the first thing I want to quickly show you is to navigate around the MT4 platform. There are 4 things, or there are 4 icons that you need to know when it comes to the MT5 or the MT4 platform. The first one is this icon called quote. All right, the first icon here is the quote icon. Now that icon looks like 2 arrows, one going up, one going down, and the quote icon is where you have all the instruments, all the financial instruments that you want to trade. It's like a menu icon where you have everything that is available for you to trade on the platform. Anything you can't find here, if you are using an Android phone, you can click on the pencil sign above, or the plus sign rather, the plus sign above if you're using an Android phone. If you're using an iPhone like myself, you can just click on the enter search symbol, and then you can see other folders. Let's say you want to trade ETFs, you want to trade stocks. There are other folders for you to trade. You can see metal. For example, if I click on metal, I'm going to see gold, which is XAUUSD. I can click on this and I can go back. Right, I can click on this and I can go back, and then it will be added. Once I click on it, I will go back, it will be added. Now let's quickly go to the next icon, which is the chart icon, like you can see there. So once you click on the chart icon, it's going to bring you to a chart like this, and there are some things that you need to also understand when it comes to the charts. For example, you can decide to increase your chart, you can decide to reduce your chart. All right, you can increase, you can zoom out, you can zoom in. It depends on what you want to do. At the same time, on the MT5, you can also use your finger to move the sidebar, to move the price bar. All right, you can move it up, you can move it down. It depends on what you want to do. Okay. You can also change your time frame. For the Android phone, once you click on your screen, you will see a blue circle where you have something like this: M1, M5, M15, M20. And every other thing. All right, so you can decide to do whatever you want to do. You can decide to use whatever time frame you want to use here. So I'm just going to be going with the M15 time frame, which is the 15 minutes time frame. Now what does 15 minutes time frame means? It means that every candlestick we are seeing here for this instrument, which is AUD/USD, we are going to be using the 15 minutes time frame. All right, the candlesticks are in the 15 minutes time frame. That's what it means, simple as that. And the next thing is trade. So this is where you know if you are on a trade. If you're on a trade, this is where you close your trade. This is where you take your profit, whatever you want to do. And then we have history. History is to tell you how much you've made. You can actually see all the profits or the losses you have made for the year, for the week, for the day, for the month, depending on what you're looking at. If you want to get for the month, you can just click on this clock sign. For Android phone, it's going to look like I think it's also a clock sign for Android phone. You can just click on this, and then you can schedule, you can custom, you can pick anyone you want. Very simple. All right, so let's come back here. Let's assume that we want to take a trade on gold. What are we going to do? What's the first step? The first thing you want to do is to click on gold. You're going to see open chart. You click on open chart. It's going to load the chart for gold, right? So let me just quickly do this. So what we want to do is that let's assume that we want to take a sell. All I just need to do is to click on these 2 icons up here, the one that looks like a clock and the one that looks like a box. But I'm going to be going for the one that looks like a box because that is where I have my buy and my sell. And if you look at the middle of that buy and sell, you have 0.03, which means, if you remember, 0.01 means a micro lot. So 0.03 means 3 micro lots. All right. So I can decide to go for, because I've increased my capital to $100,000, I can decide to go for 0.05 or even 0.1. All right. And then I can decide to say, okay, you know what? I want to sell gold. So I can decide to go for a sell on gold. So I click on sell, and that trade is being taken for me already. Once you go to trade now, you can now begin to see that your trade is currently running, and you can decide to close it in profit. You can see it's already in profit. I can decide to close it in profit right now. I can decide to close it if I want to close it right now, but I'm still just going to leave it. Now, once I take my trade, what is the next thing I want to do? The next thing I want to do is to do my stop loss, and I also want to do my take profit. On the MT5, it's very, very easy for you to do your stop loss and your take profit. There is a drag and drop method of doing this that makes it very, very easy. Now, how do I do this? Very simple. All I just need to do is to, first of all, click on the red line. Once I click on where I have my sell like this, excuse me. Okay, so let me quickly do this with my phone. So click on the red line. Once I click on where I have my red line, it's going to bring SL and it's going to bring TP. I need to click on SL. So once I click on XL, I can just drag this. Let's assume I want to do my stop loss here. I can just drag and drop. For my TP, I want to do my TP here. I'm just going to drag and drop it here. Then I click on this blue arrow and it takes me and it says modify. I just click on modify and that's all. I've been able to place my trade. As simple as that. All right, very, very simple, very straightforward, very simple. Now let's do one more. Let's do another type of order. So this is called an instant market order, where I take the trade immediately and I can see profit immediately, like I'm seeing the profit right now. All right, but there's another type of order called a pending order, when it's not going to be immediate. All right, so let's quickly look at what a pending order is. Let's open Euro USD. Let's go to charts. We can see that the price of Euro USD is going down massively on the 15 minutes time frame. Let's look at the 1 hour time frame. Same thing. If you go to the daily time frame, also same thing. The daily time frame is also pushing down massively. It has just broken a 50 period moving average. If you don't know what that is, don't worry. We're going to be talking about that in the coming modules. Now, let's quickly go to the 15 minutes time frame. Let's assume that we are expecting this price to come back up. We are saying that very soon the price is going to push up and it's going to start going up from here. We're just saying, right? And we want to take a buy here if that happens. But we might not be here. We can't be here for the whole thing to happen. We are very busy, right? After this, I have a lot of things to do, so we might not be here till this thing happens. So what I want to do is that I want to do a pending order that would a buy pending order, so that anytime the price goes up and gets to this particular point, I can actually take my trade without stress. It will just trigger for me. So what I want to do is I want to do a pending order, a buy stop pending order. It's called a buy stop. So we have the sell stop, which is going to be in the case where I want price to come down to come to this point, and I want to enter at this point, but price is not there yet. I can use a sell stop that anytime price gets there, it triggers my trade. But I'm going to be going for a buy stop since I want to buy, and I'm saying that if price comes back up, anytime price gets there, it triggers my trade. What do I do? Do I click on the box? No. What I need to do is to click out the box and then click on the one that looks like a clock for the pending order. And then I just need to drag and drop to where I want it to be. Let's do this again. So I'm just going to drag this. Let's take this off. So I'm just going to drag this to where I want it to be. I want to take my trade here. I'm seeing a sell limit, so I just click on that sell limit to change it to a buy stop. All right. Then I also want to have my stop loss done immediately. So I want to say if price is going against me up to this point, stop my trade for me. I want to also have my TP. If it goes up to this point, stop me in profits, right? So I click on the blue and I click on place. This type of order is different from this one. This is not instant. You can see this is saying placed, while the other one is in profit already and is running. It's going into profits, coming into losses. It's called an instant order, that first one. But the one we have just done now is called a pending order. So it's pending the time price is going to get to these levels that we have been able to set for it. Pending the time price is going to get there, it will keep waiting. So this is the type of order that we have. We have the instant order and we have the pending order. So please go ahead to practice more based on what you have just learned. You can rewatch this thing again over and over again, and you can also join our live classes Mondays and Wednesdays to be able to get more knowledge about this, and special classes that we're also going to be organizing. Just make sure that you are speaking with your BD or your CS to be able to get more information about when we're going to be having our classes. But we have these classes every week. All right, but this is just to break down everything we have learned so far. Now, talk about margin and free margin. If you look at this trade on Euro USD, on gold, if you look up, you will discover that we have what is called margin. So the margin requirement for this trade was $372 because I took a 0.1, that was a mini lot. I'm buying 10,000 ounces of gold. I'm selling 10,000 ounces of gold, and I don't have the money to even purchase to go for that trade. So my margin requirement is 372.90, which means I still have a free margin of 990. Sorry, I still have a free margin of $99,652, right? And you can see the way the margin is moving. Okay, so this gives me a lot of room to be able to take more trades and to be able to hold this trade until it is profitable, if I still believe that the market is still going to go in my direction. So this is the essence of free margin, margin, leverage, and everything we've talked about. This is the practical aspect. So go ahead to open more trades, take more trades, so that you are able to practice this over and over again. I'm going to be seeing you in the next module, where we're going to be talking about fundamental analysis and how to take advantage of the market when the market is very volatile. How to take advantage of the news in a very volatile position. I'm still going to be leaving this trade because I believe that gold is still going to be moving in my direction. We can see that Euro USD is already moving down, so I believe that gold is still going to move down. So I'm still going to leave this. But what is the worst thing that could happen? The worst thing that could happen on this trade is that the price is going to go up and it's going to hit my stop loss. It's going to stop me out. I'm not going to lose beyond that. So I am not scared. As a trader, my mind is already prepared for this. I've already accepted the risk, because trading has has risks, and you have to be able to accept those risks before you even enter your trade. But like I said, I believe this is still going to go in my favor. The price is still going to go down because it's a downward trend already on the 15 minutes time frame. So we should see some level of short sales, and yeah, that makes it a fantastic time to actually hold on this trade. Whoa, can you see that? I told you. All right, that's why it's not good to always jump out. All right, and this is still going to move much down. It's still going to go more down, and we're still going to make more money here. So I'm going to be seeing you in the next module. All right, so if you have made it this far, I really want to congratulate you, because you have really gone, you've come to the last two modules of this training. And if you have not attended, if you have not listened to other modules from module 1, introduction to who EBC is, to module 2, talking about introduction to financial trading, to module 3, where we talked about terms and terminologies. We're also talking about practical navigation. We looked at a practical aspect of navigating around the MT4 and the MT5 on the phone. And right now we are in module 4, which has to do with fundamental analysis. This is going to be talking about introduction to fundamental analysis. All right, I'm going to be talking about what fundamental analysis is all about, and I'm going to be breaking it down so that it's very beginner friendly to anybody who is going to be listening to this. No matter your level in trading, this is beginner friendly. All right, so very quickly, let's jump into it. What exactly is fundamental analysis? What exactly is fundamental analysis? Now, let's quickly see this analogy. I like using this analogy a lot because it breaks down the myth. It demystifies what fundamental analysis is all about. Now, if you look at this picture, you discover that there is somebody here driving a truck, and this guy has a load behind his truck. The load behind his truck is called demand and supply. All right, so demand and supply is essentially what affects price. There is no price without demand and supply. As traders, we don't make money if there is no demand and supply. There have to be an imbalance between demand and supply for us to know, for price to either go up or go down. And the level of the demand and supply also determines the level of the volatility of the price movement in the market, right? So price is a very big thing. Price is the major thing we are all looking for. Price, understanding what price is doing and taking advantage of what price is doing as a trader is what is going to give you profits. And that's the old business of trading. If you would summarize the entire business of trading, what you've been learning from module 1 up to module 5 is just looking for ways to understand what price is doing, to take advantage of what price is doing, and to make sure that you are on the right side of price movement with very good risk management. That's all. All right, so demand and supply is a very big part. In fact, it's the major part of our business. Everything centers around demand and supply. But as powerful as demand and supply is, as powerful as the place of demand and supply in price movement, you will discover that demand and supply is useless and would not move anywhere without this driver driving it. The driver determines if this demand and supply is going to go forward. It determines if it's going to go backward. It determines the speed at which demand and supply moves. So the driver, even though is at this particular point, is not as important as demand and supply. Everybody's focus is on demand and supply. But guess what? The driver has the say over how fast demand and supply move, because he's the one driving the truck, carrying demand and supply. And so therefore, a lot of times I meet a lot of traders that will tell me, oh, it's all about technical analysis, it's all about understanding what the chart is saying. You don't need to understand what any other thing is saying, just know what the chart is saying and all that. Now, all that is good. I was also like that too in my first 2 to 3 years of trading, until I understood that you could have the best chart movement, you could have the best chart structure, you could have the best chart knowledge, you could understand structures, you could understand how market moves. But I can tell you that when you're trading an instrument like gold and stocks, your structure can be violated, in no time, if you don't pay attention to the driver of those structures, if you don't pay attention to price. And that is why it is very, very essentially important that you pay attention to the driver and you are familiar with the characteristics of this driver. And the driver here, in the sense of this business, is no other person than the news, ladies and gentlemen. The driver of price, the driver of demand and supply is the news. I was in a seminar some 6 months ago, somewhere in Nigeria, and I was having a physical training with over 200 people in the seminar hall, and I was talking about something very, very funny. And I was telling them that a bottle of water in Nigeria right now currently goes for 200 naira. All right, just one bottle of water. But do you know that with the right news, the price of one bottle of water can go as high as 1,000 naira in a single day with the right news? The news is so powerful that it can take price from nothing to an all-time high, and it can also bring it from an all-time high to an all-time low. It depends on how powerful the news is, because the news is the driver of price. And as a trader, understanding how to take advantage of this news is key to getting yourself in the right side of price movement. So let us quickly look at what the news is all about. So fundamental analysis studies the political, economic, socio-cultural, and physical environmental factors that impact the global financial market. So there are 4 pillars. There are 4 fundamental pillars to price movement. Number 1, we have the political pillar, political news. All right, political news from major countries like the United States. All right, then we have the economic news, economic outlook, economic calendars. All right, these are GDPs, your CPIs, your PPIs, etc. All right, we have the socio-cultural news. These are news that has to do with race, there are news that has to do with war, and a lot of things like that. And then we have the physical environmental news, and these news are news that has to do with epidemics like the coronavirus that we had last time. Anything that affects the physical environment, including natural disasters. All right, these are the 4 fundamental pillars that affects the market. Now take notes that these 4 fundamental pillars must be happening around developed economies. For example, Nigeria is not part of, did I say developing economies? Developed economies. They must be happening around big countries, big economies, developed economies, top economies of the world. All right. Nigeria is a developing economy, or I would like to say an emerging economy. So anything happening, any political news, economic news, cultural news, or physical environmental news coming from Nigeria would have an impact on Nigeria economy, but it's not going to have an impact on the global economy where our business is. So paying attention to major countries like the United States and the rest is a major advantage. And these are the kind of countries that you want to pay attention to when it has to do with fundamental analysis, because they determine what happens in the global financial market. They have more say, they have more market capitalization in the global financial market than every other country in the world. And it's very, very important you understand this key fact. All right. Now, these factors are essential because the market reacts to the information generated by these factors. Now, long-term trends on the needs and huge movement are watched because of the fundamental factors behind them. What it means is that fundamental analysis also determines the trend. All right. For example, gold has been pushing up massively for months right now because of the news coming from the United States. We have the news of war with Israel, Iran, and and the rest. We also have the news coming from the White House itself on tariff, sanctions, deportations, and a lot of other things. There's a lot of things going on. In fact, there was a rumor allegedly some weeks ago that was actually targeting the president of the United States directly, and it was not a good rumor, and there were facts to back it up, and this affected the markets because anything that has to do with the White House, that has to do with the United States, that has to do with anything connected to the United States would always affect gold. So for months and months right now, since Donald Trump became the president of the United States since last year November, the price of gold has been going up massively. It has been on an upward trajectory because of the kind of fundamentals that has been coming from the United States and the sentiment of people around what is going on in the United States, sentiment of investors to be precise. All right, because they also affect the market a lot. Now, economic forces, economic indicators, geopolitical environment, fundamental announcements, and human psychology mainly drive the price. The last one is very, very important: human psychology, because the whole essence of fundamental analysis is understanding the news. It doesn't just stop there. It doesn't just stop at you knowing what the news is saying. It also goes further to also make you understand how investors are perceiving that news. What is the psychological state of investors to that news? Are they scared? Is the news bringing fear to them? If the news is bringing fear to them, it means they are going to start pulling off their investment in dollars if the news is coming from the United States, and then maybe putting it into euro or putting it into gold. More importantly, more majorly, they're going to be putting it into gold. All right. So it's very, very important you understand. Apart from you understanding the news, you also need to understand the psychological state of the investors and of traders in the market, so that you can be in the right trajectory of price when the news comes. All right. So let's quickly go to types of news. There are two major types of news. We have the scheduled news and we have the unscheduled news. We have the scheduled news and we have the unscheduled news. Under the unscheduled news, we have the micro and we have the macro. So let's start with scheduled news. What are scheduled news? Scheduled news are majorly economic outlook. The word scheduled means that we know that they are going to happen. They have been scheduled to happen, and the time is already there. They are already stamped. It's going to happen, right? So we are expecting the news. That's why it's scheduled. So we know that by 1 o'clock tomorrow morning or 1 o'clock tomorrow afternoon, the president of the United States is going to be giving a statement that has to do with the economic policies, or Jerome Powell, which happens to be the Fed chair, is going to be giving a statement that has to do with the monetary policy, like the last one they did for the FOMC convention. All right, so it's a scheduled news. We know it's going to happen. We're going to be looking at how to understand scheduled news in this training now. All right, just stick around. Now the next one is the unscheduled news, which is the micro, the macro. Unscheduled news means you didn't plan for it, which is the thing that has been happening to gold throughout this year. A lot of people have been complaining, and I can tell you guys, there's been an exciting time with gold. Trust me, not just gold, every other instrument out there, but majorly I trade gold. So it has been an exciting time with gold. It has been an exciting time with every instrument that is tied to the dollar this year, right? Because there has been a lot of unscheduled news, a lot, from wars of Israel tied with US, with other countries like Iran, to Donald Trump giving announcements, sudden announcements, breaking news, on tariffs, on a lot of trade wars going between US and every other country, to a lot of things that is also happening around the United States economy that is not scheduled for. That's we are not even, we don't know. We just wake up in the morning and you just see, oh, there is a breaking news. All right, and it's, of course, the market will move. It will affect the market. So now there are breaking news that are of little scale and of little effect on the market, while there are some that is of large scale and of large effect in the market. That's why there's micro and there's macro. And then we also have a major type of unscheduled news, which is also, like I said before, a global scale pandemic, which a very good example is the COVID-19, the coronavirus that we had some years back. All right. which affected the market, every part of the market, from stocks to indices to commodities to currencies. Everybody was affected. All right, so let's quickly talk about some of this news. Now, scheduled news example is natural disasters, terrorist attack, pandemic, breaking news. I've mentioned all this. Scheduled news example is economic outlook, majorly GDP, PPI, CPI, FOMC conventions, and speeches by head of banks, speeches by head of countries. All these are scheduled news, and we're going to be looking at how to get scheduled news. Now, the very most important thing you need to understand about scheduled news is the fact that they determine a lot. So, but before we talk about that, let's quickly talk about two examples of scheduled news. Number one is interest rates. Now, interest rate is very, very important because interest rates affect the psychology of investors. All right. So, what is interest rate? Let me just break it down, and I'm going to bring it down to Nigeria. All right. So, interest rate, for example, in Nigeria is the amount of money you get by putting your money in the bank. So, when you put, let's say, 1 million naira in the bank is saying if you put 1 million naira in the bank, annually we're going to be giving you 21% return on your return of interest on your capital, right? So you have 21% return at the end of the month, at the end of the year, annum return. So that's interest rate. All right. So if I have another country like Switzerland offering me 40%, I would rather take my money from Naira and then deposit it in the Swiss bank to get 40%, a higher return, and it makes more sense. And then not just about the return, also we talk about the safety of the capital, the safety of the financial institution. All right. So let's break it down now. Let's now see how this affects investors and their mood. Let's say, for example, there is a plan to cut interest rate, just like what just happened with the United States dollar, where there was an announcement that the interest rate will be cut. There's going to be a cut on interest rate, and that immediately made the price of gold to start moving very erratic. In fact, it was crazy, right? For almost a week, even up to the time I'm having this lecture right now, the price of gold is still moving up. Now, what really happened is simple. If we're cutting down interest rates, what you're saying is that we're going to be reducing the amount you've been getting on your capital. So let's say you're getting 21%, you've been getting it for the past 5 years. All of a sudden, we are saying, you know what? We can't pay you 25% anymore. We're going to be cutting it down to maybe 18% or maybe 20%. And that's going to affect my money. It's going to affect my return, and it's business, right? So what I want to do is that I want to quickly remove that money if I'm not comfortable with the amount I'm getting, and I want to put it into gold. I want to diversify that money into maybe a particular stock or a particular index, right? And I want to make more because I feel I'm going to make more money. Now, remember, I'm a business person. There is no hard feelings. It's just business. If you're not going to give me something good, then I should be able to put my money somewhere where I'm going to get something good. So anytime there's an interest rate cut, this actually drastically affects the price of dollar in relation to gold in the market, and most of the time the price of gold begins to push up. So it's always an important thing to note that interest rates for any country, not just for the United States dollar, including euro, the euro. Parts of Europe, UK, Canada, Australia, any major country who is cutting or increasing interest rate, or whatever, relaxing interest rates, you need to pay attention to it because it's going to affect the economy. It's also going to affect the currency, because the other part of it is that if I'm increasing interest rate also, of course, it also means that I'm trying to mop up the money from the economy, because I'm trying to encourage people to save more than borrowing, right? Because if I'm borrowing money and there's an increase in interest rate, it means I'm paying a higher interest on what I'm borrowing, right? So, but if I'm saving money and there's an increase in interest rates, it means I'm making more money. So it encourages savings and discourages borrowing, which means it mops up the excess money in the economy. But sometimes also when that leads to what is called when that leads to an adverse effect in the economy, then it has to also be relaxed so that people can also borrow, and then there could be money in the economy again. So there's a balance that must be striked between increasing the interest rate and reducing interest rate, and that is why FOMC, which is the Federal Open Market Committee, which is a very, very important union, a very, very, very important bureau a very, very important department in the Federal Reserve, holds the responsibility for determining the interest rates after really critically looking at the economy and what the economy really, really needs. If they need to relax it, if they need to increase it, they determine all that, and that is why it's very, very important to pay attention to the speeches that they're going to be giving. It's also very, very important to pay attention to the head of banks like Jerome Powell. Another very good thing you need to understand is that when it comes to speeches by head of banks, there are two types of speech. All right, we can say it is a dovish speech. We also have what is called the hawkish speech. All right, so the dovish speech has to do with when the speech is signaling a downward movement of the economy. The speech is signaling the price moving down. Right, the economy is not doing so well, but the hawkish speech is signaling a steady increase in economy, and it means the economy is doing well, and these are things that also affect the confidence of investors on the economy, and also eventually determines if they are going to move their money from the banks to other portfolios in the global financial market, which eventually also affects the market. So let's quickly move on to the next thing, which is very, very important. A very important one that you need to pay key note of is the employment situation report. Majorly from the United States. We have this for major countries, but United States is the major one. This happens every first Friday of the month. Almost all the time, except there is a special celebration where it needs to be postponed or where it needs to be rescheduled. But if nothing changes, every first Friday of the month, by 1:30 Nigerian time or 2:30 Nigerian time, depending on the daylight savings period, you have this. Now, many years ago, even before I came into the business of trading, 10 years ago, I've been hearing about NFP. In fact, one of the first fundamental term I learned was NFP. Non-farm payroll. It is now known as non-farm employment change. I think it was changed about 5 years ago or 4 years ago. I can't remember correctly, but it was formerly known as non-farm payroll, NFP. And even till now, people still refer to it as NFP, even though it's now non-farm employment change, right? So, but people still know it as NFP, which is non-farm payroll. What does NFP actually talks about? What is the whole hype about NFP, and why is it so important to pay attention to it as a trader? Not just NFP, including CPI. CPI also is a major measurement for interest rates. But let me start from NFP, then we'll go to CPI. Now, NFP is an employment situation report that measures the number of people that has been employed in every sector apart from the agricultural sector. All right, it measures the number of people that have been employed in every sector apart from the agricultural sector, month in, month out. All right, so month in, month out means every month we get a report of the number of people that has been employed. Not just that, NFP comes out with what is known as two other major key employment situation reports. The first one is the unemployment rate, which, of course, from the name you already know what it's talking about. Unemployment rate tells you the number of people that are unemployed month in, month out, and then the average hourly earning, if there has been an increase in the average hourly earning month in, month out, which is a very, very key economic factor, a major economic outlook when it comes to understanding if the economy of the United States is doing well or not. All right, so it's very, very key. All right, when we talk about these three major things. Now, when this news comes out, it tells you, if the news is positive, it tells you that the economy of the United States is doing well, and then you can invest more money into their banks, because it's, like I said, it's not just all about the interest rate, it's also about the security of my funds, to know if the economy is doing well, to know if I can keep trusting them to keep delivering on their promise, right? Without me waking up one day and then they're cutting interest rate or doing something. The next thing also is for you to also understand if people are being employed or not. And if people are not being employed, it means the economy is not doing well. So this is a very, very key factor for traders to really be able to take advantage of, to, because when this comes out, it affects the market. The market begins to move in a very short period of time. You can make you can have 500 pips movement in a very short period of time, whereas normally that 500 pips movement would have taken you maybe 3 hours, 4 hours for you to get, or maybe 2 days, 3 days, even a week for market to move 500 pips. But when this news comes out, when all these news we've talking about, once they are out, you can move 500 pips in a twinkle of an eye. The price of gold, the price of commodities, the price of anything you're trading could move very, very fast, giving you maximum profits in a very, very short period of time. So they are very, very important key factors that you need to take advantage of. All right. Now, talking about CPI. CPI also, like I said, is an interest rate indicator that tells you what the market is actually doing in terms of interest rates. It is called core consumer price index, and it's a very, very important key economic outlook that tells you what the inflation is looking like, not just interest rate, rather inflation, what inflation is looking like, which is also a very, very important key factor in determining interest rates. Now, when the news is out and the economy and the news is bad, it tells you that the economy is weak. And when the economy is weak, it means that it is bad for the currency. The currency begins to go down. But if the news is out and the news is strong, the news is good, it means the economy is strong, the economy is good, and that means the currency begins to go up. All right, so you can see when news is bad, goes down, news is good, goes up. Now take cognizance or take observations of the color. You can see bad news is red, good news is green, because this is going to be very important when you are doing a business. All right, this is going to be very important when you are doing business. All right, so let's quickly go into some practicals right now, and then we can now begin to see where to get our news. So where do you get this news from? The first one is, of course, major news channels like CNN, Bloomberg, Al Jazeera, Rice TV, and etc. And we can also get this news from major economic calendars. As traders, I recommend 2 major channels, and well, 3. Right. The first one is the EBC Economic Outlook website. The EBC Economic Outlook that we have on the website. Every week we update you, give you the economic outlook on the website. All right, so you don't need to really go anywhere. On the website, you can get the economic outlook, know what the news is talking about, know when they're coming out, and it helps you to really get yourself abreast with whatever is happening in the market. Number 2 is Forex Factory. We're going to be looking at that promptly now. We're going to be looking at Forex Factory very, very soon with our phones, how to navigate around Forex Factory, how to take advantage of the news on Forex Factory. The next one is investing.com, which I also recommend. Investing.com is also very, very good, for understanding the news, understanding not just economic outlook. Investing.com goes further to give you the sentiment around the market analysis, and a lot of other things. All right. So let's quickly go and do some practicals and on our phones to really understand how this news work and how we can take advantage of it. I'm going to see you in the next slide. All right, so we are here, and we are currently on my phone. So I'm just going to go to investing.com. We're going to see how to take advantage of that. Let's quickly go to Forex Factory. Forex Factory. I'm going to be doing Forex Factory alone. Like I said, we also have all this economic outlook on the EBC official website. You can also access this on the website. So it's not really a big deal. Now this is investing.com. This is Forex Factory, and we can see that we already have the scheduled news from 21 to 27th. Today is Saturday, 27th. So let's quickly go to next week. So I want to know the news that we have for next week, Monday. What I'm going to do is I'm just going to select Monday, 29th here, and it's already giving me 29th. Can we see that? All right, so it's already giving me 29th Monday, and we can see that these are the news that we have for Monday 29th, and so we have there are 4 things you should pay attention to. Number 1 is the time of the news. Number 2 is the currency or the economy that the news is affecting, just like what you see here: euro, pounds, euro, USD, pounds, dollar, like that. All right. The next thing, which is extremely important, The next one is extremely important, is the impact of the news. The impact of the news, there are 4 types of impacts. We have the white folder, which is the lowest, almost no impact. We have the yellow folder, which is very low impact. We have the brown folder, like you can see here for the first one, for the Spanish flash CPI. And then we have the last one, which is the red folder. The red folder and the brown folder are the major ones that you want to pay attention to. But for this lesson, I'm going to be sticking to the brown folder and the red folder, but I'm going to be speaking to more of the red folder, because the red folder is even much more high in impact than every other folder. So I'm just going to come here to this funnel, and I'm going to click out every other folder, just leave the red folder there. What I want to do is I want to remove bonds. I want to remove I think I will just remove bonds, and I want to pay attention to, so you can also, for the currency, you can also just pay attention to the dollar. Since I trade gold, I just want to pay attention to the major economies. I'm just going to pay, I don't trade NNZD, I don't trade CHR, I don't trade this, I don't trade that. Okay, I can leave this, I can leave USD card. I do USD card sometimes, so I'm just going to apply filter. So you can also do this based on your preference. All right, so let me just apply filter. Good. So let me just go for the whole of next week. Okay, the whole of next week. I want to go for the whole of next week. So what I'm going to do is that from Monday 29th down to Monday. Okay, so 30th. Can we just have, can I just custom? Okay, good. Good. So we have it now. So I now have the whole of the week. So for Monday there is no major news, but on Tuesday, which is 30th of September, by 3 p.m. Nigerian time, I'm going to be having what is called JOLT job openings, which is a very, very important news. You can see the folder is red, all right, which means by 3 o'clock, we're going to be getting a job opening by JOLT, which essentially talks about the employment situation of the United States, and this news is going to be massive. And the reason why this news is massive, the reason why every news is massive in this week, is because this is the week that is leading to NFP. Remember I said NFP comes out every first Friday. So this is the news, these are the news that's going to be leading to NFP. In fact, if you understand fundamental analysis properly, you can even determine what NFP is going to look like by understanding what JOLT job is saying. If you get what JOLT job is saying, if you understand what ADP is saying, ISM is saying, unemployment claims is saying, you can determine what the non-farm employment change or NFP is going to be looking like on Friday, and you can even predict, you can take your trade before the news comes out. All right, so we are having this news all red folder. We have ADP by 1:15 p.m. Nigerian time on Wednesday. By 3 p.m. Nigerian time on Wednesday also, we also have ISM manufacturing PMI. You don't need to really understand. If you really want to go into what this news looks like, you can just tap, and then they tell you, when you tap the news, you tap on the yellow folder, it would give you the news. All right, so you see level of a diffusion index based on surveyed purchase manager in the manufacturing industry. If you go down, you see more information about the news, and you can also do your research, but you don't really need all this. Let me show you how to take advantage of this without really being a guru of the news. You don't need to pay attention to that. All right, what you need is to wait for the actual of the news. The actual of the news. Once the actual of the news comes out, there are three colors. You could have it in green, you could have it in red, and you could have it in black. Once the news comes out, it could be green, red, or black. If the news is green, if the actual is out by 3 o'clock, if this news is out and is green, it means the news is good and the dollar is going to be going up, most likely than not. All right, and then gold is going to be dropping a little bit. Now, if the news is red, which means the news is bad, dollar is going to be going down, gold is going to be going up, and then for every other currency pair, the same thing. For example, Euro USD now, Euro is number 1, dollar is number 2. If dollar is going down, it means Euro is going up, right? If dollar is going up, it means Euro is going down. So for Euro USD, what I want to do is that if dollar is going down, it means Euro is going up. It means I want to buy Euro and sell dollar. So I'm going to be buying on Euro USD. If the other way around is the situation, and then the dollar is going up, let's say the news is good, then the dollar is going up, and then the Euro is going down, it means I want to sell Euro USD. Now, this is very, very important. Whenever you're trading currencies and you're dealing with the news, please take note of this, because this gets a lot of people confused. All right. Let's assume that the price. Okay, let's quickly go back to the last week. Good. Let's go to this final GDP. All right, and then unemployment claim, which came out last week, Thursday, 25th. Now, this news was good for dollar. All right, and so let's assume that I am trading Euro USD. So let's go to Euro USD. This is Euro USD. Let's assume I'm trading Euro USD. I'm on the chart of Euro USD, and the news just comes out, right? And the news is, like we can see, is good for dollar. The news is green. The color is green. I told you there are 3 colors: green, red, black. Black means there is no change. It's just the same. Indifferent. So when you see the actual of the news as black, just forget about it. Don't trade it. But red and green, perfect. You can trade red, you can trade green, depending on what is coming out. Now, if you look at this news now, we are seeing that the news is good for dollar. So if I'm trading Euro USD, which means dollar is the quote currency here, or the counter currency, while Euro is the base currency, what am I doing? Am I buying or selling? See, I want to quickly say this, and this would help you. When it comes to buying and selling on currency pairs, the first currency is what you are buying or selling. I repeat, the base currency is what you are buying or selling against the counter currency. You see, forget about the dollar that you have here. Forget about dollar. Dollar is just there as a counter currency. All right. The major thing you are dealing with is the base currency. So whether the dollar is strong or good, or you want to buy or sell, remember you can't buy or sell dollar. You can only buy or sell the base currency, because the base currency here is euro. So you can't buy and sell. You can't even touch dollar. It's only euro you have business with. So if dollar is strong, what do you think will happen to euro? It means euro is going to be going down against the dollar, because if dollar is stronger than the euro based on the news, then it means euro has no choice than to bow down to dollars at that period of time. So if euro is going to be going down, it means I need to sell the euro. And if I sell euro on this chart, what have I done? I've sold euro to buy dollar. If I buy euro, it means I've bought euro to sell dollar. Vice versa. As you see the market going up here now, who do you think is going up? It is euro. As the market is coming down now, who is coming down? It is still euro. But against who? Against dollar at every time. If it is going up, it is going up against dollar. If it is coming down, it is coming down against dollar. So every time is always a battle with the dollar, but you don't see the effect of the dollar is seen by the movement of euro. So you can only buy or sell euro, because euro here is the base. However, in the case of USD JPY, where USD here is actually the first currency, which means USD is the base. In this case now, the case is different, because JPY is now the quote. So anything you are doing here, whether buying or selling, you are actually dealing with dollar, not JPY. So if the price is good for dollar and dollar is going up, it means you need to buy dollar. But if the price is bad for dollar, dollar is going down, it means you need to sell dollar. So in this case here, you can only buy or sell dollar based on because dollar here is the base currency, while JPY is the quote. If the news comes out for JPY also, and JPY is strong, and which means JPY is going to be going up against dollar, which means USD JPY is going to be coming down, because dollar here is remember I told you that the base currency is what you are seeing. This movement is all about dollar. JPY, yes, is moving against it. For example, when dollar was going up here, JPY was going down. At this point here, JPY was going down. All right, when dollar was going up, JPY was going down. At this point where dollar was coming down, it means JPY was going up. But you can only see the movement of dollar, whether it is going up or going down here, because dollar here is the first currency, is the base currency, and so we can only see the movement of dollar. We can't see that of JPY. We can only see that of JPY through the movement of dollar. So we know that JPY at this point here was going down, because of course dollar was going up. And dollar is paired against JPY in this pair. You understand? All right. So please take note of that. Anything you are doing when it comes to news trading, you are doing it to the base. You are doing it to the base. All right. The reason why I'm sharing this with you is because some years ago, somebody took the news of NFP came out, and the news was very good for dollar, and somebody started buying Euro USD because she thought that since the news is good for dollar and dollar is number 2 here, it means dollar probably Euro. Anytime you got price going down is for Euro, price going up is for dollar. No. Whatever you're doing here on this chart now is on Euro. Dollar has no business here. The only way you can see the dollar movement here is through the Euro movement. If the Euro is going up, it means dollar is going down. If the Euro is going down, it means dollar is going up. As simple as that. All right. So if dollar is going to go up, it means Euro is going to go down. Yeah. So it means I need to sell the Euro. Means I need to sell on Euro USD to take advantage of price movements on dollar, because dollar is going to be pushing Euro USD down due to the fact that it's stronger due to the news. Now, how do I take advantage of the news? Based on there are 2 ways to trade the news. You can go with a pending order like I taught you in module 3. You can say, okay, I want to go for a buy stop. Let's assume that the news is going to be coming out now and it's almost 3 o'clock. I can go to a 15 minutes time frame or even a 5 minutes time frame. Let's go to a 5 minutes time frame. Excuse me. I could go to a 5 minutes time frame and I could say, okay, you know what? I want to mark key major zones. All right. So I want to mark my first zone. This is the major point. This is okay. Don't get yourself confused. So I talk about zone. I'm going to be talking about zone in our next module. If you don't understand what zone is, don't worry. All right. So zone just means support and resistance. All right. So this is a major zone here. This is a swing zone here. This is another swing zone here. So you can see that this price is between here and here. We have a high here. A high means the highest price, the highest place that price got to here in recent time, and then we have another one, the lowest price here that price has gotten to in recent time. Forget about all these ones. I'm talking about recent time within this movement here. So based on this, I can say, okay, if price is going to go up, it's going to have to break this point. So I can say, okay, if price is going to go up, it has to break this point, right? And if the price is going to go down, it also has to break this point. So there are 2 things that could happen in this market. Price could be good for dollar, and then Euro is going to go down, and then price is going to break the down point. Or price could be bad for dollar, and the Euro is going to go up, and then price is going to break the upper point. I don't know what's going to happen, but I know that either of the 2 is going to happen, right? So I can go for a pending order to say, okay, I want to have a buy stop above. I want to have my buy stop here, right? And then I want to have my sell stop here. You see, I could do the 2, and then do my stop loss, do my take profit, and then I take advantage of the market. Very, very simple. All right. Possibly by from next month, which is October. If you're watching this, I don't know when you're watching it, but by October 2025, we're going to start doing live NFP trading, so that we can begin to do all these things practically. Okay, so that's that about that. And then another way to take advantage of the news also is to wait for the news to happen. So when the news happens, and then you just jump into the trend. If the news is going down, it's going up, and then you just jump into the trend. Take 20 pips, take 10 pips, and then you're out. Depends on how you want to trade it. So that brings us to an end of this particular module. We're going to be practicalizing all this in a more practical class, where we're going to be having a dedicated live webinar on how to trade the news. But this pretty much gives you an idea of how to trade the news. And if you understand how to do buy stop and sell stop from the last module, it's pretty easy. You can just go straight into trapping price before price moves, so that you can actually take advantage of any movement of price. All right, so I'm going to be seeing us in module 5, which is the last module, where we're going to be talking about technical analysis. We're going to be talking about some key levels in the market, how to see key levels in the market. We're going to be talking about strategies on how to trade, and I'm going to be teaching you a major sweet strategy that has helped me over the years in getting profit from the market. A formula I use that works for every market. So stick around, and I was going to see you in the next module. All right, it's a wonderful time to be at this point right now. Welcome to module 5. Here we are going to be talking about technical analysis. All right, and I'm really, really excited because this is the last module for this series. After this module, we are going to start doing you start joining our live classes. If you have not been joining before, we'll start having special webinars and seminars to discuss some special strategies. So it's a very, very exciting time, because at the end of this module, you should have all you need to start making some money on your own. I'm going to be teaching you what technical analysis is all about, and the basic things that you need to start making money. So let's quickly go into it very fast. We start without wasting any time whatsoever. The first thing I want you to understand is that when it comes to technical analysis is the type of analysis, is that aspect of analysis that talks about you understanding the language of the market. Because guess what? Every language is a code. Any language you have out there, from English to Spanish to dialects, whatever dialect you speak, right? It's a code, all right? It's an encoded message. The same message but different codes. For example, I can say come in different languages. The same message but different code. So understanding the code gives you an edge to understand the language. For example, this is a language, but it has been encoded in such a way that if you don't understand the code, you can't interpret this. If you're not somebody who is familiar with the codes used in civil engineering. Same thing here. If you're not familiar with these codes, you can't interpret this message. This is a song, and this is a song encoded in a song book, right? So if you don't understand what this is talking about, you cannot decode this message. It will not make a lot of sense to you. Same thing here. All right, so this is also a code. This is a programming language, and if you don't understand, basically what this is, if you're not familiar with it, it will not make sense to you also. So when it comes to trading, take note, this is a code. This, ladies and gentlemen, is a code. So your job as a trader is understanding how to decode this. Once you're able to decode this, you have nothing to worry about. So one of the major things we're going to be doing today in this module is understanding how to decode price. Understand how to decode what you have in front of you right now. All right, so technical analysis is all about understanding how to decode what price is actually saying. And the very simple thing that you need to understand is that technical analysis is pretty simple, and it's something that anybody can get ahead of. Now let's quickly talk about some of the things we're going to be talking about. We're going to talk about definition of technical analysis. We're going to talk about some of the tools that we use, just some of it, because we can't cover everything here. We're going to talk about the benefits, and then we're going to talk about strategies. Let's start with the definition. Number one, technical analysis is defined as the study of past price activity of an asset in order to forecast the future price direction of on the chart. So for example, or in summary, what we're just trying to say is that the history determines the future. The history determines the future. For example, every December, for example, this year December, the price of rice, gari, and beans and granite oil, where do you think it's going to go? Of course, it's going to go up, right? If you have guessed up, you're correct. If you guessed down, you're not correct. All right, so the price is going up. Now, how do we know the price is going to go up? Well, we know because every time it is December, the demand for these things goes up due to the festive period of Christmas, and that causes the price to go up. So I know the price is going to go up this December because I know what the past I know how the price has reacted in the past during festive period over 10 years, right? And guess what? I can invest money right now to go and buy chicken, for example, to start raising chicken to sell by December, and I will make my money back. I will make very good money back because people are going to buy chicken. People must buy chicken by December this year, right? So I am buying into chicken to sell by December. I'm going long on chicken to sell by December based on the history, based on the information of the past. And I know that I am 99% sure that I am going to make my money by December because the price 99% assured is going to go up. The remaining 1% is not going to be based on risk management, where I cannot have my risk management to say, okay, if it doesn't go up for any reason, which it's going to be very rare, at least I have my risk management in place to mitigate that trade if anything goes wrong. But we know that 90% to 99%, nothing is going to go wrong, right? So technical analysis is all about understanding what the past of price is saying and using that past price market activity to predict or forecast the future price movements on the chart. It's as simple as that. So your chart, as a trader, your chart, just like what this guy is doing, your chart is giving you history. Your chart doesn't give you the future. You can't see what's going to happen. What has not happened on your chart. You can't see it, but you can only see what has happened every minute, every hour, every day. What your chart is printing for you is the history of price, and your job is to understand how that history might affect the future, to understand how to use that history that the chart is giving to you to predict what the future is going to look like. And that is all about, that is what technical analysis is all about. All right. So let's quickly move to the tools that we use in technical analysis. Number one is indicators. There are different type of indicators. There are trend indicators. There are oscillators. There are different type of indicators, right? So we have indicators, then we have trend structures. We have patterns, of course, we have candlestick price action, and then of course we have the support and resistance. So there are different ways to trade, there are different tools to use. There are people who uses indicators to trade, people who uses just trend of the market, people who uses patterns. Patterns can be people who are using smart smart money concepts, other blocks, all these are patterns, Wyckoff patterns, all these are patterns. Then we have candlestick price action, which is the one I majorly use, and then we also have support and resistance, which are pivot zones. But you see, support and resistance are actually, whether you're using indicator, trends, patterns, or in candlestick price action, support and resistance is a major thing, because it's like I said, is the very foundation of price movement. So you would always find it everywhere. But there are people who major on support and resistance alone, drawing trend lines everywhere and just using those trend lines to trade, to determine support and resistance levels and just trade around those levels. Now let's quickly go to the next thing. Why is technical analysis very, very important? Number one, it helps a trader to know the future price movements. I've mentioned that. Number two, it helps a trader to know where and when to buy or sell by studying the past price activity on the chart. Number three, in trend analysis, it helps you to know more about the characteristics of price movement, such as reversal, retracement, and continuation. So price moves in three ways, right? Some people will say price moves in comprehension. It will compress. So compression, release. There are a lot of terms for it, but the major term is reversal, retracement, continuation. Reversal, retracement, continuation is also a major term. So reversal means the reversal of a trend. Retracement means within the trend, the little pullbacks within the trend, and then continuation means, after that pullback, price moves again in the same direction. And we're going to be looking at all this here. All right, we're going to be looking at all this. All right, so this is different from the compression or accumulation phase, and then the releaser phase and all that. This is different from all that. Break of character, break of structure. This is different. All right, I mean changing character rather. This is different from all that. This is just looking at what happens within a trend. All right, the retracement, the continuation, and then the reversal eventually. Okay, so let's quickly look at technical strategies that you can also use to trade. We have support and resistance strategy, we have candlestick strategy, and then we have the hybrid trading indicator, which means you can actually use both indicator trading strategies, and you can combine various indicators together to actually trade. And we're going to be looking at some few indicators in this module as we continue. So let's really go to the major thing right now. The first thing I really want to share with you is that, ladies and gentlemen, trading is easy if you have two things. Number one is a trading plan. Number two is a strategy. A lot of people start trading with strategy, right? Just, if you have the best strategy, you start making money. I can give you for a fact from experience, you would make money, but it will not be sustainable. You will not be able to sustain that money you're making. You will not be able to make money continuously in a sustainable way. The only way to sustain your income in trading, that it becomes continuous, it becomes sustainable, it becomes something that you can always do, is when you have a trading plan and you stick to your trading plan. It's very, very important to have a trading plan and to stick to that trading plan. So what is a trading plan? A trading plan is a plan, a business plan that talks about what you are trading, the volume you want to use to trade, the capital you're starting with, what is your target for profits per day, your target for losses per day, what is your strategy. In your plan, you have your strategy. What triggers your buy, what triggers your sell, what makes you to stay out of the market, where are you, what time zones do you trade? All these are embedded in your plan. You see, that is the reason why my first book in this business was called The Complete Trading Plan, because I understood after 2 years of making money, losing money, making money, losing money, I understood that the only way to trade and to make this business something that you can actually bank on, make a career out of, is by having a plan. And it's been a very good journey for me. Right now it's been a very fantastic journey for me. After 2 years of losing money, and I got this understanding, till now I am still in the business of trading, making money daily. It's been a very fantastic journey for me, and anybody can achieve this. And that is why I'm sharing these secrets with you. You will not get this anywhere out there. You need to have a trading plan. Trading is not just all about strategy, all about the best signals, all about flipping accounts. No. If you want to gamble with your money, yeah, you can do all that. But if you really want to go into the business of trading and really make a side hustle or a major hustle out of it, have a trading plan. Very, very important, right? So I can't go in depth into this right now. Maybe we're going to be having a special class on this. Please speak with your BD or your CS, and also follow us on our social media platforms, so that you can be getting more information. Also follow us on Telegram, so that you can be getting more information about where we're having special trainings, live trainings, where we talk about all this. But make sure that you have a trading plan. All right, now let's really talk about one of the major problems that every trader has. So let's come back to strategy. Let's leave trading plan, let's come back to strategy right now. Now, as a trader, the only problem that everybody has as traders is, how do they buy and sell? Where do I buy and sell that give me profits? How do I understand this? And all this is simply, understood if you have a very good strategy. And that's why strategy is very, very important. But like I said, strategy is not the only thing that gives you profit. Strategy gives you a start, but having a plan keeps your business going. All right, now let's really talk about how price moves. Talking about strategy, now we want to solve this question. Now, how do I buy and sell? Where do I buy and sell? How do I enter the market? We want to solve this question. The first thing you need to first understand is price mechanism. How does price move? Let's go to a local market in Nigeria. This is local market in the Benin city, popularly known as Edo State, in Edo State, Nigeria. This is the same Benin kingdom that we are all familiar with. Now, this is Benin city, and in this market, I don't want to mention the name of the market, but in this market, they sell majorly gari, which is cassava flakes in English, but it's locally known as gari. Now, in this market, we can see that this woman who is selling gari, she's very happy. Why is she very happy? Let me tell you the reason why she's very happy. Because yesterday night, all right, a night before this morning, the governor announced that there's going to be a 1-week lockdown in Benin, and that everybody must go and get whatever they need to get the next morning, which is this morning now, right? So gari is a very essential commodity to have at home, because you would need it. Trust me, you would need it. Gari is needed by everybody, right? So she's very happy because she knows that the demand for gari, based on that news, based on that fundamental, is going to be it's going to be pushing the price of gari up. She's going to sell a lot today, because she's in the main market and she has enough stocks. All right, so let's quickly look at how the price is going to move. Is the price just going to jump from, let's assume that a basket of gari is sold for 500 naira before the announcement was made? So is the price just going to jump from 500 immediately down to 2000? No, there's going to be a systematic way of price movement most often than not. So let's quickly look at how price moves. Look at this, and this is where continuation and retracement comes in. Now, at first, we see price moving from 500 naira down to 1000 naira, which at 1000 naira, maybe between the hours of 8 o'clock in the morning to 10 o'clock in the morning, price moves from 500 naira to 1000 naira, which is the highest point at that period of time. And the price comes down a little bit to 800 naira. So you could, between 8 to 10 o'clock in the morning, you could get it. Some vendors were selling for 1000, some vendors were selling for 800. So the 1000 at that period of time, we call it the high, because that is the highest price as at that time, and the low is 800 naira, which is the lowest price. Now, this low is a retracement from 1000. So this low is not, this retracement here, this 800 does not mean that the price is going down. Oh, because you saw it at 800, the news is no longer effective. It means the price is not coming down because I could bargain for 800. No, it's just a retracement. Now, between 10 o'clock to 12 o'clock, we now have more demand in the market. The price has pushed up again. Guess what? Price has broken the previous high. Ladies and gentlemen, the price has gone above 1,000. From 800 naira, it has broken the previous high. It has gotten to a new high. And this new high is at 1.5. All right? And this new high is at 1.5. But guess what? You cannot, sorry, let's assume the new high is at 1,000, yeah, 1.5. But guess what? So if you can bargain very well, you could also get some people who are willing to sell for 1,000 naira, which is now the low. Now, don't forget, 1,000 naira was formerly a high, remember. But that 1,000 naira now is now a low to the new high of 1.5. So we call this new high a higher high, a high that is higher than the previous high. Why this low? Even though it's lower to 1.5, it is still 1,000, which means it's still lower to that of 800 naira. So we call this a higher low. So if price is going up, we will see this movement, this kind of movement, retracement continuation, breaking the previous high, retracement continuation, breaking the previous high, and we say this structure is called higher highs and higher lows. Higher highs and higher lows, where this high is the resistance point and this low are the support zones. Resistance, support, resistance, support. And we can see price keeps breaking resistance and it doesn't break support. So any market movement that keeps breaking resistance is an upward movement. It means price is going up. It will keep breaking resistance. It will not break support, but it will keep breaking resistance. It means the price is going up. It's an upward movement, right? But in the case of a sell, in the case of a downward trend, let's say after 1 week, they now, relax or call off entirely the lockdown, and everybody can now go back to their normal business, and there is no rush to buy anything anymore. Of course, the price will begin to drop. And when price begins to drop too, it also drops in a very systematic way. You can see the high price of maybe 2,000 naira and maybe the low price of maybe, let's say, 1,800. After some hours or after some days, price drops again to a new low. All right, remember this was 800, this was 1,000. Price has dropped to a new low now of, let's say, 500 naira. And then the new high will now be 800. Take note of that. Remember, in this case too, the new low was 1,000, which was the former high. So every time price breaks a zone, it goes back to retest that zone. Which means, if I want to take a trade and I see something like this, I would wait, ladies and gentlemen. I would not, if I miss this movement, I would wait. Because entering here now is too expensive. You need to enter at a support level for an upward trend. If price is going up, you want to enter at the support level. So you want to wait for price to get to a new high anytime it gets there, because you know that once it eventually gets there, it would most likely than not retrace back to the former zone it has broken, which is 1,000. And when it gets there, if it's truly an upward trend, it would create a continuation, bouncing off that point back up. Very simple, sir. So I know what I'm waiting for is price retracing back here, and then I am entering here, and then following this continuation to make some level of profit. So the same thing for a sell. Same thing. All right. So price breaks a particular zone of support. This is a low. It has been broken. In this case now, price keeps violating the low. Price keeps breaking the low. This is a lower low. And I know that once price forms a lower low, it's going to go back to go and retest the former low that it has broken. And you can see I enter my sell here, and the price goes down again, goes back to retest the former one that is broken. I enter my sell here again. All right. So at a downward trend, you want to enter your sells at a resistance. At an upward trend, you want to enter your sells at a support. So I will be entering my sell. Price goes up, comes back to a support. I enter here. Now price has broken this one again. Remember, this is a resistance. Price broke it to give us a higher high, then comes back to that same place it has broken. You can see I will wait for it to come back here. I will just draw a line, a trend line here, waiting for it. Once price comes back here, I enter. My stop loss is going to be here. My take profits can be at this zone it has gotten to before, and then it bounces off that point to the next place. Of course, I'm waiting again, right? I know it's going to come back to this place it has broken, because it has broken. For it to come here, it has to break this one. It has given me a higher high. I know it's going to come back. So let's go and mark it. If you mark it, you can see it came back here. I enter here again. And you can see price has broken this one again, the higher high. I know it's going to come back to this zone. All right, so I wait for it. It comes back there again. I enter. Very simple. Very simple. Same thing for a sell, right? So price breaks this place. goes down, breaks this level of support, and you can see that price retraced back to that zone, I would enter here, right? And then price breaks this one again. You see price breaking it, goes down. I know it's going to come back, so I'm not rushed. I'm not in a rush. If I enter here, I've made my profit, I'm out, I'm waiting for the next movement. Price comes back there again, I'm not in a rush, I enter again, and then you can see price breaks this one again. Of course, it's going to come back to retest it. Very simple, very easy, straight to the point. Now there are three types of movements, right? We've mentioned the upward movements, the downward movements. This one is lower lows, lower highs, lower lows, lower highs. And then we have, of course, the consolidating movements, or the sideways movements. It's not going anywhere. It's not going up, it's not going down. It's just bouncing around two major zones. All right, this is known as a consolidation, or what's another word we can call it? A sideways market. It's just going sideways. It's not really going anywhere. And this, we're just waiting for a breakout, a retest, and a continuation. Breakout, retest, continuation. Breakout, retest, continuation. So if we see something like this, you want to wait for price to break out, to retest that point, and then continue. And you want to enter at a retest. All right. Okay, so let's quickly move to the next thing. Now, the general rule for trading is buy at a support, sell at a resistance. So, and before you can even talk about buy at the support, sell at the resistance, you must, I've mentioned this, price must, for you to even want to buy at all, price must be going up. It must be on an upward trajectory. It must be an upward trend before you can now say, okay, I want to buy at a support. If it's not at an upward trend, forget about it. All right, you are not buying anything. So if price is going down too, you want to sell, good. That is when you now say, okay, I want to sell at a resistance. So this buy low, sell high, it depends. It is determined by the trend. It is determined by the trend. All right. So don't just buy low, sell high. You first of all need to understand the trend, and then know the zones, the support and level, the resistance zones in that trend, and then you know what you are doing. All right. So let's quickly move to the next thing. Candlesticks, introduction to candlesticks, right? So this is a very, very important aspect of this training because we're going to be looking at candlesticks. Now, in this candlestick formation, we have two types of candlestick. We have the bullish, which is this green one here, and we have the bearish, which is this red one here. But what makes a candlestick bullish or bearish? Is it the color? A lot of people don't know. People think, oh, if the candlestick is green, it's bullish. If the candlestick is red, it's bearish. No, sir. It's not the color. No, ma. You're wrong. What makes the candlestick bullish or bearish is the open and close price. The open and close price is what makes the candlestick bullish or bearish. Candlestick has four parts. Most of them has four parts, right? We have the high, the close, the open, and the low. Except it's a Marubuzo candle where you don't have any high or low, right? So you can actually have two parts. So the most important part out of all those four parts is the open and the close. If the open is lower to the close, meaning that if the close is higher than the open price, when I say open, I'm talking about price, so high price, close price, open price, low price, right? So if the open price is higher than the close price, then there's a problem. It means the candlestick has closed lower. But if the close price is higher than the open price, it means the candlestick has closed higher, which means the candlestick has gone up. So a bullish candle has a close that is higher than the open. So let me quickly let's quickly break this down because this can be very confusing. This is very simple, ladies and gentlemen. Listen, if you go to the market to buy rice, for example, and the open of the market in the morning, the price of rice, the open price of rice, as when they opened the market, was 1,000 naira. And later in the evening, around 9 o'clock or 9:30, when the market was going to a close, people were closing up their shops, they were going home. The price of rice is now at 2,000 naira. So the close price is 2,000. That's what we're talking about. All this open and close that we're talking about, it's just price, right? So what we are saying is that the close price is higher than the open price. 2,000 naira closing price is higher than 1,000 naira open price in the morning. And that tells you that the price eventually for the day has gone where? It has gone up from 1,000 to 2,000. So that's a bullish candle because demand has pushed it up. So a demand candle is a bullish candle. It's a kind of candle that, demand actually influenced the candle. But in the case where price opened at 1,000 naira in the morning and then closing at 500 naira in the night, that tells you that the price has gone down. It means that the demand was not so much. People did not really buy, or one thing or the other has led to make supply to be more than demand because people didn't buy. There was enough supply, but people were not buying it, so the price had to drop. And that is a bearish candle because it is influenced by supply. All right, so it's as simple as that. Now let's quickly go and look at support and resistance on bullish and bearish candle. How do I get my support and my resistance on each of these candles? It's very simple. Now remember, a bullish candle is a candle that is going up, a bearish candle is a candle that is coming down. It's not about the color, but we're going to make it easier to just color code it so that we know that, okay, green candle means that it's a bullish candle, candle that's going up, red candle, bearish candle, most likely than not. But like I said, it's not about the color, it's about the open and close price. So if you look at this, now you see that this candle is going down. All of a sudden, this candle started going up. There must be something that must have happened. Let's do it again. Price is going down, all of a sudden, it bounces off a point and begins to go back up. This point where it was stopped and this red green candle begins to push back up. Imagine this candlestick as a ball. So the ball was thrown down and then it hit a pavement and then the ball bounced back up. While it was coming down, it was giving us a red signal. When it was bouncing back up, remember, it's still the same ball, it's the same price. Hey, ladies and gentlemen, there is no difference in price. It's the same single price, but different indicators. If it's coming down, it's going to be red. If it's going up, it's going to be green. The same price. It's a ball. Coming down, it was red. It bounced on a pavement, on a particular thing. Something, it bounced on something and it's going back up. The color changed to green. What did it bounce on? What has caused it to go back up? That level is a level of support. So anytime you see a red candle come down and then you see a green candle immediately go up. That point at which that happened, the base of those two candles lies a support. So when we say support, we are talking about the base of a red candle and a green candle. Red candle, green candle. At the base is a support. As simple as that. The other one, you can see the price going up, bounced at a particular point and then it's being dropped down. So when you throw a ball up and the ball is going up, it will keep going up if you have enough force, if it doesn't hit anywhere, any pavement. But even if you have a very enough force and you throw the ball up and the ball should have gone up 30 feet, but at 2 feet there is something that is stronger than the force of the ball, it will bounce it back down. That is what's happening to price here. So we can see price going up, bounced on something and then the price is dropping. That thing it bounced on is called a resistance. So when you see a green candle going up and all of a sudden a red candle begins to come down, at the top of those two candles is a resistance. As simple as that. So for example, if I show you something like this now, all right, let's quickly zoom in on this. If I show you this now, let's say from this movement to this movement, how many supports do we have? It's simple. Remember, a support is seen at the base of a red candle and a green candle. So we see a red candle here, right? And we see a green candle here. This is support number 1. Red candle, green candle. Support number 2. Red candle, green candle. Support number 3. Red candle, green candle. Support number 4. What about this one? This is green candle, red candle. So it's not the same. It has to be red candle before green candle. All right, red candle, green candle, support number 5, red candle, green candle, support number 6. So let's stop here. And then the same thing applies to every other one. But professionally, we can also see that this support and this support is the same. It's the same force. There is a platform here that is acting on all of them. After price broke that point, price came back to retest it. You can see a retest, like I told you. All right, price will always come back to retest most often than not. I will enter my buy here, my stop loss is here, take profit is above. But anyway, that's not what we're talking about right now. Now you can see when price came back to retest, when it got to that point, it's continued, right? And we can see another support here. All right, and then we see another support here also. So it's as simple as that. What about resistance? Resistance is green candle and then we see red candle, right? So this is resistance number 1, green candle, red candle. Resistance number 2, green candle, red candle. Number 3, green candle, red candle. Number 4, green candle, red candle. All right. What about this one? No, this is red candle, green candle. So this is a support. Green candle, red candle, resistance. Green candle, red candle, resistance. Green candle, red candle, resistance. All right. So it's very, very simple. It's very straightforward. And it's something that you don't need to really disturb yourself all about. Now let's talk about price behavior. How does price behave? It's very simple. There is a rule that I came up with. It's something that I noticed and it's something that you need to also know. Now the rule states that anytime a support is being broken, that support is going to be retested. When that support is retested, it's going to become a resistance. So when a support is broken, it becomes a resistance. And when the resistance is broken, it becomes a support. As simple as that. That's just the rule. So what we are saying is that if price, this is a resistance now, price breaks this resistance point, gets to the next resistance, which is the next high. So this was the previous high. Price gets to the next high, and then it comes back to retest that previous high. That previous high becomes a support. And you can see price bouncing from it, breaking this high again, getting to the next high, coming back again to retest the previous one. This one becomes a support, breaks it again, come back to retest. This becomes a support like that. So I want to enter my buy here. I want to wait for price to retest and then enter my buy. So I know where the retest. See, I can predict based on past market activity. Even though I've not seen all this, as long as price breaks this one, and this is still an upward trend, I can predict that the price must come here most often than not. It will come here. I know. I can predict it. So I am not just waiting. I know what I am waiting for. I have marked the zone. I know that it's going to come back to that zone to retest. And when it does, I can take my trade, because that is the best place to enter. Because if I enter here, my stop loss is going to be very tight. It's just going to be here, just below the zone. My take profit, I can leave it open, or I can take profit at this point here, because I've not seen all this. This has not happened yet. Remember, as at this point, we are just seeing the retest. So let's assume that this has not happened yet. So I can only see what has happened in the past, which is this highest point. So I can go for a take profit here, because I don't know. Price can reverse from this point. But I know that even if it's going to reverse, it's going to get here first, right? So I can take my profit here, or I can say, okay, based on the fundamental, this is still going to go up for a long time. Let me leave my take profits open and then just begin to do what is called a break even. I'm going to teach you what break even is in a special class, all right? If you don't know what break even is already. Okay, so it's very, very important to take note of this rule. Same thing for a sell. All right, same thing for a sell. You can see price breaks a low, it goes back to retest that low. You can see this is the low. So let's assume that I missed this trade, I missed this sell. You don't need to worry yourself. If you miss this, just wait. What are you waiting for? You are waiting for a retracement, for price to go and retest where it has broken. Where has it broken? Oh, it has broken the previous low to give us a new low. So we just have to wait for price to go back there. So when price get there, what are we doing? We're taking our sell, right? And then we can see that price got there and then dropped. Of course, if you miss this one also, price will always go back to retest this particular point. We can see price comes back again to retest here, and we can see this one was even retested twice. It was a 2 times retest of this before price finally broke down and then came back again to retest within that zone again the 3rd time. So it's very, very simple, straightforward and straight to the point. Now, if you're trading and you've been trading for some time, and because you want to be wiser than price, your chart looks like this. You want to be seeing the future. It doesn't work that way, sir. It doesn't work that way, man. You need to understand that you can't see the future. You can only predict the future. And you don't even need all this to predict the future. It's as simple as just what I've just showed you right now. So let me give you a quick tip on how to start your day in trading. Number one, before you execute a trade, you need to identify the instrument you want to trade. You need to know what you want to trade. Very, very important. You need to be, like I said in some of the modules that we have talked about, you need to be, don't be a jack of all trades, just pick one. I trade only gold. Gold has given me millions. All right, gold has given me millions. All right, trust me, millions. And I don't need to trade any other instruments. Gold alone is okay for me. I trade only gold. All right, so you don't need to be a jack of all trades. Just pick one. The next thing you need to understand is you need to identify. Once you know the trade, once you know what you want to trade, identify, the trend. Is it going up? Is it going down? Is it going sideways? Very, very fast. And then number two, you need to also know if it is going up, I want to buy. Where am I buying? I want to buy at the support. Is it at the support? Yes, then you buy. If it's not there, you wait for price to retest until price gets there. If it's not going up, it's not going down, it's just consolidating, then you stay out or you wait for a breakout. If it's going down, that means it's a sell. I want to sell. Where down to sell? I want to sell at the resistance. The price goes back, it breaks its low, and it goes back to the former low where it's going to give me a resistance. It's going to drop from there. If it gets to that resistance, I want to sell. If it doesn't get there, I'll wait until it gets there. Very simple. Straightforward. Very simple. But this is what made me to now, write the second book I wrote, which is called The Almighty Trading Formula by myself some years ago. And I'm just going to summarize what this formula talks about and how you can use this. And then we're going to do some practicals. We're going to look at some major practicals, some case studies using the phone, using the chart on the MT5. But let's really look at this. The first thing you need to understand is that this formula works for every market. everything you're trading. It's called the MZE cube. MZE cube formula. The M stands for market structure, the Z stands for zone of interest, the E stands for entry trigger, E stands for exit if you are right, the other E stands for exit if you are wrong. So essentially, know your trend, know the support and resistance level of the trend, understand what triggers your entry in those levels, and then have a take profit point and have a stop loss point based on market structure. So let's quickly look at it practically. So I'm going to pause it here, but before I pause it here to go to the phone, let's talk about entry trigger a little bit, and then let's talk about entry trigger a little bit. So there are 4 types of entry triggers that I really want to talk about. The first one is the buy entry trigger, which is the hammer. Now, a lot of candlestick patterns out there, but these are the ones I think that is most needed. So we have the hammer. This is how the hammer looks like. We have a long wick, and then we have a small head. Just like what you're saying. It can be green, it can be red, it's fine. If you see this in an upward trend around the support zone, it's a very good trigger to buy. Then we have the bullish engulfing. Bullish engulfing means a bullish candle engulfing a bearish candle. All right, a bullish candle swallowing up a bearish candle or overshadowing a bearish candle. And then we have the sell entry trigger. We have the inverted hammer, the shooting star. Some people call it shooting star, some people call it inverted hammer. It's just the opposite of this. And then we have the bearish engulfing, which is just the opposite of this. We have a bearish candle engulfing the bullish candle. There are other major candlesticks. There are different types of candlesticks. We have the doji, the evening star, but these are the 4 most important ones I have seen that are very repeatable. They are very repeated rather, and you see them more often than not, and they are very, very useful, very powerful also. All right, so we're going to be looking at this as we look at the phone, as we go to the phone to begin to now check the charts. And I'm on gold. So let's assume that you wake up in the morning, you want to trade, you want to make some money, you open your chart, and let's assume you trade gold or you trade any other instrument, and you open the instrument and you have this chart. All right, so what's the next thing you want to do? Now remember, at this point you're asking yourself, do I buy, do I sell? What's the market structure looking like? Don't forget the formula. The formula is market structure, zone of interest, entry trigger. Those are the first 3 important things. And then we'll have exit if you are right, exit if you are wrong. But the first 3 is very, very important. So let's quickly look at those first 3 first. Market structure, zone of interest, entry trigger. What's the market structure here? How do I get the market structure? Market structure essentially talks about, is the price going up or is the price going down? Is the price going up or is it going down? That's essentially what market structure is talking about. So what do we need to do? All we just need to do to get the market structure is to click on F and to add a moving average. We're going to be adding a 21 period moving average. Shift to 0, method is exponential, apply to close. Just follow this. It's very easy. If you are using an Android phone, instead of you clicking on F, you will click on N with a sign like it's sign in the middle. It's like a Naira sign, right? So just click on that and you have the same thing. If you're using an MT4, it's going to be F. So just make sure that this is toggled to the end so that you can have a very good line. I'm going to be using red, and you can see my moving average line is already there. Now, what does this moving average do for? What does it do for me? It's very easy. Now, the moving average tells me what price is doing. It gives me the market structure. It also serves as my zone of interest. So we have, at this point here, the moving average here is telling me that the price is consolidating. It's not going up. It's not going down. It's just consolidating. So how do I know it's consolidating? Because the moving average is cutting across price. It's just in the middle. It's not above price. It's not below price. All right. But in a case like this, look at this, guys. Look at this. This is sweet, right? This is telling me that this is a bullish movement. This is an upward trend. How do I know? Because the moving average is below price and the price is trading above the moving average, and we can see how very smooth this looks like. The same way also, if you see something like this, even this is a downward trend. Can you see this? But let me even go and look for a better downward trend. Gold has been going up, so we have more of an upward trend in recent times on the 1 hour time frame. But I'm looking for this is also a downward trend, but I'm looking for a very decent one. Okay, this is also a very, very good downward trend. So this gives you an idea of what the moving average can help you do. This is an upward trend, and then we have an upward trend to a consolidation. You can see price moving up and then came here, direct consolidating before price broke downwards. All right, so this gives you a rough idea. Okay, this is a very good downward trend right now. You can see this very good downward trend. We can see. Okay, we can see. So we're going to be starting with this downward trend. Let's assume that we want to trade based on this downward trend. Okay, so let's assume we want to trade based on this downward trend. This is where the downward trend started from, when we saw this candlestick breaking this moving average, closing below the moving average here, and then price continued downwards. Now let's assume I want to trade here. What do I need to do? I need to look for the entry trigger. Now I know my market structure is a downward trend. I know my zone because the moving average here is serving as a resistance, and I want to sell from a resistance, so I'm selling from the moving average. So the next thing is my entry trigger. What triggers my entry? Of course, we talked about two types of entry trigger for the sell. We have the bearish engulfing pattern, we have the inverted hammer, and both of them happened here. We can see the bearish engulfing pattern. Look, I see this bearish candle is bigger than this bullish candle. This is a bearish engulfing pattern. At the same time, this guy here alone is an inverted hammer. This guy here, this guy, see it, it's an inverted hammer. We can see it hanging from the moving average. So all this gives me a very good bias, a very good trigger for a sell. I will take my sell at the close of price, at the close of this candle here, right where this blue arrow is, right? I'll enter my sell here. My stop loss is just below the moving average because that's my zone of interest. My take profit, I could leave it open, or I could take my profit at the last level of support. If I go back down, if we go back to go and check the last level of support, oh wow, look at the last level of support here. This was the last level of support. So we could take our what's it called, this was a recent level of support, so we could take our trade there, and of course price got there, ladies and gentlemen. That would have been a very good trade. That is a 1 to 4, meaning that you are risking 1% to make about 4%. If we missed that trade, we could have waited for price to retrace, to retest again, and at the retest we will look for another entry trigger. Let's look for an entry trigger. Okay, so there was a retest here, right, but there was no entry trigger. We couldn't see the kind of entry trigger we're looking for until we saw this movement. Now this is not an entry trigger I've taught you, but this is called a hanging man. Anytime you see a hammer, it's called a hanging man, a bearish hammer under the moving average. All right, it's called a hanging man, but I've not taught you that. I actually taught you bullish hammer and inverted hammer, but there's another one called the hanging man. Anyway, this would have been a very good time to sell again, right? If you understand what a hanging man is. But if you don't understand what this hanging man is, the first trade you got here is still very good, based on what we've talked about. So let's look for another opportunity where we can see what we are used to. We can see another hanging man there. Good. This is another opportunity that we are used to. At least this I've taught you. We've mentioned this but you know, we know that we saw an hanging man here, but we've mentioned this. So this is a very good inverted hammer. This is an inverted hammer, and this is looking very good. This is also looking like a bearish engulfing pattern also. So my sell would be here. My stop loss would be above price here. My take profit, I will be targeting this particular level here. Because this is the point at which price got to the last time before price retraced back up. So I want to target that point. So you do get that trade. Wow. So we were targeting here, and we can see our price broke that point. That's why I don't like, anytime price is moving in a trend, I don't like using take profit most of the times. I like to always break even, and then as price breaks the zones, I begin to move my stop loss into the money, right? So if you don't know what break even means, we're going to be talking about that in a very special class, and probably you need to follow us on all our social media platforms. Make sure you subscribe also, it's very, very important. Okay, so yeah, so that's about that. This is an evening star. This is another very good one. And then we saw price breaking above market here, and then into a consolidation at this particular point before eventually returning back to a downward trend, and then continuing the downward trend until price broke above again, consolidated a little bit, came back into a downward trend. Now let's go and look for an upward trend. Let's assume that price is going up like what we are seeing here right now, right? So this is a very good upward trend. We can see price massively pushing up. At this point, is it a good time to enter? No. We're waiting for price to come back down to the zone. This is the zone. This is not a support, right? So we want to see price come to a support, give us a very good entry trigger, and then we can now risk maybe a 1 to 1 or a 1 to 2 or a 1 to 3, right? So let's just look, let's continue if we're going to see something of such. Okay, here is a very good one. You can see very close to the moving average. We are seeing a bearish engulfing pattern. We are also seeing something like a doji. So I've not touched you doji, but I've touched you bearish engulfing pattern. This candle is bigger than this red candle, but it's kind of not so close to the moving average. So well, this would have been a gamble. If I've taken this trade, I would have just gone with this stop loss and a take profit of this, a 1:2 trade, and that would have still given me my profit. But let's look for a very good one that actually came into the moving average. Okay, so this was a very good one. Came into the moving average, closed. This was a bullish hammer. I would have actually taken this trade because no, we've not seen all this. So let's assume that we didn't see all this. We only saw this. Of course, I would have taken this trade. My stop loss would have been here. My take profits would have been here. I would have been targeting this level for my take profits. My stop loss, I would have been targeting somewhere here. So this is like a 1 to 1.5 ratio trade, and we can see what happened. Price actually took us out. Okay, price took us out, which is okay. Remember, a losing trade, it doesn't mean that if you lose a trade, it doesn't mean that you're a failure. It doesn't mean that you don't know what you're doing. It doesn't mean that you need to go and learn a new strategy. No, if you lose a trade, you can't win it all. It's okay to lose trades. All right, it's okay, right? This is okay, right? So we lost this trade. It's okay. We'll move on. Okay, so we quickly move on. We're looking for the perfect entry. We want to cool. This is a very good entry also. So look at this. This is a bearish pattern. We can see an inverted hammer here. Can you see this inverted hammer? We saw it here also. We saw another one here. So I could have taken this, or I could have taken this, anyone. My stop loss would have been probably around this point, and then my take profit would have been around this point. It's like a 1:1 trade, or I could have gone, if it breaks this point, then I go for a 1:2.5. And let's see if we got all that. Yeah, we got the 1:1 before price returned back up. All right, so that would have given us a break even. So let's go to a very good upward trend. This is also a very good upward trend. We can see that bearish hammer there, but let's quickly look for a very good one. Let's just go for an upward trend, and then we look at good. So this is looking very good for an upward trend. Let's start from here, right? So we saw price pushing at this particular point, from this point here to the upside. Good. And then we start looking for opportunities. Now this is our first opportunity. This was our first opportunity here. So this opportunity here, right? This was a bullish engulfing pattern, but I would not enter this trade. The reason why I will not enter this trade is because this bullish engulfing pattern is already too bullish. If I'm entering, I have to be entering at this point. It's too far from the moving average. So yeah, I'm not going to enter this. I'm going to wait for price to come back close to the moving average before I would enter this trade. And that happened. You can see what happened here. This is a bullish engulfing hammer. Sorry, this is a bullish hammer. It's also a bullish engulfing pattern. So I could have entered here at this bullish engulfing pattern, or I entered at this hammer, and then I'll be risking something around these levels. This is my risk. This is my entry, and then my take profit could be a 1:1. All right, and then let's see what happened next. You can see price pushing up at this point, and then this is another opportunity to enter again. This is another hammer again, and then I would have entered again at that point, and we can just see. So your job is just to wait for price to come to the moving average, give you an entry trigger, and then you take your trade. This is another bullish engulfing pattern here. Look at this, and I would have taken my trade. Stop losses here, take profits. I could have targeted this for 1:1, or I could have opened it up, and then you can see how much we would have made at that point. So this is another bullish engulfing pattern. Excuse me. This is another bullish engulfing pattern here. This was the first one, bullish engulfing, and then we have the hammer here also. So this can continue on and on. I can tell you that out of 10 trades, you would be making at least 6 to 7 trades using this strategy, and then with a very good risk management, you would always be at the top in your profit at the end of the week, at the end of the month, at the end of the year. All right, but you can't really use this daily. It has to be weekly. You have to check your losses and your wins weekly and yearly, and monthly. All right, so it's a very, very good strategy, and it's something I've been using for a long time, and I've taught a lot of people about it. I've written books about it. So you try it out, put it in the comment section. You can also follow us on our social media platforms to tell me how it is for you. Did it work for you? Were you able to understand it? Were you able to make money from it? Give us feedbacks. Give me feedbacks. It's very, very important for me, because I really want to know if this has really helped you. So I'm going to be seeing you in our live classes. I'm going to be seeing you in our Telegram groups. I'm going to be seeing you in our social media platforms. Make sure you're following all our handles. Make sure you're following us on Telegram. You're subscribed to our Telegram page, and make sure that you're following us to get the latest information. We're going to be dropping more videos, more educational videos, more advanced than what we've done so far. This is just beginner friendly. We're going to be dropping more advanced videos. We're going to be doing live programs, live webinars for free, ladies and gentlemen, absolutely for free, all courtesy of EBC Nigeria, all courtesy of EBC Financial Group. So make sure that you're following us on all our social media handles, and I'm going to be seeing us at the top.